Okay. Well, let's give this another go. Welcome to the second edition of uh, this rapid class that we're doing in early January. Once again, coming to you from the home office here, just because the traffic uh, situation was not exactly. I didn't feel like risking it, especially since I have a 4 mile drive on a bridge. And the traffic jams were just not very, hey, let's go out for a drive. So, doing it again from the home office here, which is good for you. It gives you a little bit better visual on the screen. But hopefully, tomorrow will be from the office. But also, tomorrow we get into the sections that are already have a video posted for, so you could watch those or you could watch the live stream. That should be on tomorrow, either way. Also, I do recommend there is um, a policy and procedure video that's on my page here. It was not live, it was uploaded. I recorded and uploaded it. For those of you that are already working for Liberty this year, I do recommend that you watch that. Strongly recommend that you watch that at your earliest convenience. But today, so we're going to cover chapters 3 and 4. So let's go ahead. And first and foremost, we have chapter 3 here. We're going to talk about the different filing statuses. Alright, so the purpose of filing statuses, the 5 filing statuses that we have, and we'll go into detail on these. We want to learn how to determine the appropriate filing status based on marital status. Identify the specific conditions necessary for each filing status, such as being legally separated, having a dependent child, or meeting the criteria to be considered unmarried. And that one's a little tricky. Understand the advantages and disadvantages of each filing status in the terms of tax rates, standard deductions, eligibility for credits and deductions. Apply the rules for determining filing status practical to accurately select the most advantageous filing status. Calculate the cost of keeping up a home to determine the eligibility for filing statuses like head of household or the qualified surviving spouse. And analyze different filing status options available to taxpayers. Select the optimal filing status based on individual circumstances, considering factors such as income, household expenses, and eligibility for credits and deductions. This is kind of overblown a little bit. I mean, basically, you don't have a lot of choice on your filing status, except when it comes to married filing jointly and married filing separately. But, I mean, yeah, there are other choices, so I guess, but it just, you fall into a category. And we just kind of go from there. If you choose a different category based on the rules, yeah, there's certain circumstances where that might be better or worse. So we'll just kind of go at it from here. Your filing status determines your filing requirement. Remember, different filing statuses have different standard deductions, which changes your filing requirements. Also changes your tax rates. Single tax rate goes up at a higher rate than head of household, and head of household goes up at a higher rate than married filing jointly. Married filing separately goes up at the single rate. And also, what deductions and credits will apply. We're not going to go into a lot of detail on that because we will mention this as we go along in future webinars about the credits specifically and which ones can be used or can't be used. And basically, we're just going to be looking at, yeah, you're married filing separately, you can't use that. You're married filing separately, you can't use that. So, on these filing statuses, first and foremost, we have our unmarried persons. You're considered unmarried for the whole year if, on the last day of the tax year, December 31st, you were either unmarried, divorced under a final decree by the last day of the year, legally separated from your spouse under a divorce or separate maintenance decree, This is governed by state law. The act of filing for divorce or separating from your spouse is not considered legal separation. If you just moved out, or if you just filed your paperwork and you haven't got everything all signed, you're still married, and you still have to file as a married person. Well, and like I said, I mentioned this in an earlier broadcast, but we talked about your filing status as of December 31st, and so we're looking at this divorce right here. It doesn't matter that you were married and the divorce didn't get signed until December. You're going to be single. It doesn't matter if you spent 12 months being married, and you had the paperwork signed right after Christmas. You're going to be single for the entire year. Married persons, you're considered married for the whole year if you're legally married as of December 31st of the tax year. You live together in a common law marriage recognized in the state where you now live or in the state where the common law marriage began. You are married and living apart but not legally separated under a decree of divorce or separate maintenance, or your spouse died during the year and you did not remarry during the year. So we'll look at these from this point of view a little bit. Again, I'll mention this is that you could have your wedding ceremony on New Year's Eve. As long as you got everything signed and the ceremony's over by midnight, you're married for the entire year as far as the IRS is concerned. Common law marriage, this is variable from state to state. I'm only familiar specifically with Kansas. Kansas, to be common law, you have to meet 3 conditions. Condition number 1 is that you had to have cohabitation for at least 6 months. Condition number 2, you're putting it out there that this is your wife, this is your husband, this is the ball and chain, this is the old lady, this is the old man. Any type of those type of comments when you're introducing somebody as your significant spouse, any of those commonly known terms. And condition number 3, you have a joint account of some sort, whether it be the cable bill, the phone bill, a lease, any of those things. If you meet all those 3 things, you're common law in the state of Kansas. Then the only way that you can get out of it, obviously, if you need to get out of it, is a divorce. This one right here, I mentioned that married but living apart. That goes even if you didn't want to get divorced. I was doing a tax return for some truckers who lived out of Washington State, but they wanted, they drive different trucks. They hardly see each other, not very often. They're married. They're filing jointly. There's no requirement on marriage to actually be together once you're married. So there's no vacation from that, shall we say, and no requirement to actually be together physically. And spouse died during the year, you're still married up until, unless you remarry. But if your spouse died during the year, you still get to be considered married for the entire year. There are 5 filing statuses that we're going to talk about. And this down here is the section of the 1040 that we're dealing with. Check 1 box. You're single, married filing jointly, married filing separately. You're head of household, or your qualified surviving spouse. And so let's get into talking about all of these. To use the single as your filing status, one of the following must be true as of the last day of the tax year. You were never married. You were legally separated from your spouse under divorce or separate maintenance decree. Or you're widowed before January 1st of, let's just say 2024 for this particular case, since this is the tax year that we'll be dealing with, and you did not remarry. So this is the tax year before that we're talking about. If it's the current tax year and you were married, you're still married. If it's the anything after that, then you got to be single. You can't be married anymore, or you can't file with them anymore as a married person. So Emma, 28-year-old graphics designer, works as a freelancer. She rents a small apartment in the city, is not married, has no dependents in the tax year 2023. Emma earned $45,000 from her freelance design projects. Emma does not have a spouse to file with, jointly or separately, nor is she qualified for any other filing status such as head of household or qualified surviving spouse with a dependent child. Therefore, single is her only filing option. Married filing jointly filing status. To use this filing status, you and your spouse must actually agree to file a joint tax return, and one of these must be true as of the last day of the tax year you were married. This does not include registered domestic partnerships, civil unions, or other similar relationships that is not a marriage under state law. You are living together in a common law marriage legally recognized by the state that you're residing in or the state where it first took effect. You're separated under I'm not going to try that word. Not final decree of divorce. Yeah, you filed the paperwork. You're just not done. It's still in process. You're still married. Spouse passed away during the tax year and you did not remarry during the tax year. Well, and that brings up its own little thing, and we'll come back to that when we talk about qualified surviving spouse. If your spouse dies in 2024 or whatever tax year that you're dealing with, before filing a 23 tax return, you may file a joint 23 tax return and a joint 24 tax return. This happens a little bit more often than one would think. I even just did one last year. The spouse died in January. She came in late February to file the taxes. Obviously she was married that year. Her spouse lived the entire year, and so she was able to file married filing jointly for that year. And then I informed her that unless she remarries, she is entitled to file one more time with her deceased spouse, married filing jointly. This year, when she comes in this year, she'll be still married filing jointly because her spouse was actually alive for at least one day of the tax year of last year, so she gets to do it again. And if she does remarry, well, then she's just married filing jointly with the new person. But somebody's going to have to do a married filing separately return for the deceased spouse. So do keep that in mind. If you were married before the end of the year, you would file a joint return with your new spouse, or you could do married filing separately. Therefore, your deceased spouse must be married filing separately for that year also. Oh, and I will mention that it doesn't matter what you did in previous years. If you were married filing separately for all those years, and then this last year you went married filing jointly, that's still your call. You could still do that. Your filing status of a previous year does not override what you can do for this year. I mean, even if you got married and died in the same year, you still get to do married filing jointly, or married filing separately if you wanted to. For that year. So, an example, Fred passed away September 1st of 23. His wife, Marlene, did not work. They filed married filing jointly in previous years. They had no dependents. Marlene is not remarried. So even though Marlene is technically not married as of December 31st of 2023, when she files her 23 taxes, she can do a married filing jointly return. If you're married on the last day of the tax year, you or your spouse can choose to file jointly or separate returns. However, both spouses must include all their income and deductions on the return, and both must sign the return for married filing jointly. Yeah, you just can't pick and choose. You have to put it all on there. Everything's on the table. There's no a little bit of this and a little bit of that. It's a complete picture. And like we said, both spouses must sign the return. For married filing jointly, you're both held responsible jointly and individually for all tax and any interest or penalty that are due, even if all the income was earned by one spouse. That is a minor drawback about married filing jointly, is that even if only one spouse has income, the other spouse was a stay-at-home, take care of the kids type person, if there's any taxes owed, it's half and half. You're married filing jointly, if 50% of the problem is responsible to you. So do keep that in the back of your mind, that it is a possibility. There is a little bit of relief on that. There is something called an innocent spouse that is beyond the scope of this particular class, but I do talk about it in the basic class. It's like a chapter 18, chapter 19 type thing. Um, so there's a little bit of relief available in this type of situation if the spouse had no call to know what was going on. Uh, Both spouses must generally sign the return to be considered a joint tax return. However, if the spouse passed away, the surviving spouse can sign for the deceased spouse, or the executor of the estate can sign for the deceased spouse. If the spouse is sick or injured, you can have the healthy spouse sign their name and their title on the line, but I'm not a big fan of doing this unless I have experience with the clients or I have the proper documentation uh, from a doctor, or even better, a power of attorney. If you do have a power of attorney, you would do it just like kind of this. The healthy spouse would then sign for the other spouse, basically like this, but instead of putting the title husband or wife, you put down POA, power of attorney, and that would be the best in this particular case. I mean, like I said, I do have a couple of clients that I know the spouses, to get them out of the house is an adventure, to say the least, because of all the difficulties it does take to get the spouse out of the house, load it up in the car, bring them out there. I've even taken paperwork out to the car for them to sign and brought it back in. But I would not have a particular problem for those particular clients. Like I said, I need some documentation, or I have to know the clients better. If this is a first-year person and I don't have any documentation of to why the spouse can't come in, I'm not very keen on doing this, and I probably won't. I would change it to paper, is what I would do in this case, and that way they could take it home, and then whatever happens from there, it's beyond my control. So therefore, if it is forged, it can't come back on me because I changed it to paper. But when I'm doing it in the office, I do have if I was doing it electronically in the office, I would have a standard that I would try and have to meet to make sure that somebody wasn't trying to pull something here. If the spouse is serving in a combat zone, the other spouse may sign. Again, there's going to be a power of attorney in it for this one. The military would actually require that. So I will want the power of attorney on this one, or this just isn't going to happen. A dated statement should be attached to the return showing the form number, like the 1040, the tax year, and the reason why the spouse cannot sign. But again, if I already have a power of attorney, or if I have the surviving spouse and have a copy of the death certificate, I don't need to necessarily worry about this part of it. It's just part of it'll be scanned in as our packages, and that way if the IRS does actually inquire about that, I've already got a PDF of everything, and I can send it back to the IRS. For married filing separately, the status may be benefit of some taxpayers if they want to be responsible for only their tax, or if it results in less tax than filing a joint return. Well, we already know that it's going to be taxed the tax on income grows at a higher rate, so there's very few times that married filing separately would actually result in a lower tax bill. Most of the time, it will result in a higher tax bill, just by the way that the tax tables are set up. Taxpayers who are married as of the last day of the tax return either choose to file separate returns or cannot agree to file a joint return. This one here, this is you divorcing couples that just can't stand each other. I already mentioned before that we can have divorcing couples. They're still married. They're just not finished with the divorce yet. They can do married filing jointly. They don't even have to be in the office at the same time, ever. They just have to drop off their stuff. We put it together. Each of them can get their own copy of the 1040. That's not an issue. Like I said, we can have them come in at separate times to sign. We could do remote signatures. There's not a lot to this. I've done this tax return before. It's not really all that different. Your hardest part is trying to figure out how to what to do with the refunds if there are any. The last time I did it, uh, the one spouse who was not keeping the children said that any refunds can go to the other spouse who was keeping the children, because it was he looked at it as from the point of view it's good for the children, and that's the way we did it. We just sent the return to her account, the refund to her account. I do have situations where also married filing separately is not exactly the worst case. An example, I had a couple that were very old. They were in their 70s. Their original spouses had died earlier, but they didn't like the idea of these being alone these years, and very much old school that if you're going to be living together, you better be married. And that's what they did. They got married, but when they came in, they did married filing separately tax returns, um, because they wanted to make sure that his stuff was his stuff, her stuff was her stuff. That way, when one of them died, that it wasn't very complicated. His stuff was his stuff, and her stuff was her stuff. There wasn't any concern about having to divvying up anything. So they filed separately, and of course, for that age and their income type and income level, it wasn't very painful for them because basically they're not going to qualify for any tax credits. So I'm not looking from the point of view as, well, if you don't file or if you do married filing separately, you don't qualify for this credit or that deduction. It wasn't a concern for them. They weren't going to qualify for anything anyway. Um, and it just, and it wasn't a problem. I will say that on a married filing separate return, that Circular 230 ethics would say that as a tax preparer, you should not do both returns. You should pass off the other return to a different preparer. There's no reason why the office can't do both of them, but ethics would suggest that the same preparer shouldn't do both of them. Now, there is an exception to that if both parties are fully aware of what's going to happen, is that if the same tax preparer is going to do both returns, they know that in advance, and they agree to it. You've met your due diligence for ethics on that, and you can go ahead with it. But I still would be more comfortable on a married filing separate return, like on the old elderly couple that I did. I did do both of them. They knew in advance. They wanted me to do it. They agreed to it. So no ethical dilemma. But I would still be more comfortable if you could have had a second person, because there was another case where I did do something like this, and it was a divorcing couple. They couldn't agree. I don't understand the situation totally. They came in together, they like each other, but they were just getting a divorce and they didn't want to file together. I did pass that one off because it was a divorcing couple, and I just didn't want to be caught in the middle of that one. So I did pass his return off to the other preparer that was in the office at the time. Using the married filing separately status disqualifies you from certain tax benefits, such as claiming the standard deduction if your spouse itemizes deductions. Well, we already know that the standard deduction is going to be low. It's going to be at the single rate at 13.8 or whatever it is for that year. And so if the first spouse comes in and claims all the deductions, and when the second spouse comes in, first, they're probably not going to know that the first spouse itemized and took everything, unless the first spouse sent them a text and say, nah, I took all the deductions. You have to file. You have to file a Schedule A. They're most likely going to get a IRS letter later saying, oh yeah, hey, by the way, you're married filing separately. Your spouse married filing separately, itemized, so you don't get a standard deduction. Here's what you actually owe in tax. But if you do know that, if you do know in advance that the first spouse did a married filing separate return and took and itemized deductions, your client has to itemize deductions, whatever they can prove. And if there is some situation where you know that for instance, both spouses happen to come into the same office, you happen to come across, you did the first one, but you knew the second one you found out the second one was coming in later, you cannot divulge the fact that the first spouse itemized. That's confidential information. At married filing separately, the returns do not cross. The second spouse has no right to know what was on the first spouse's return. So you cannot divulge information that the first spouse itemized. You can't look it up. You have to go with what the second spouse tells you, and if it results in a letter, well, that's something you can deal with later, because the IRS will say, well, you have to itemize. But even if you know in advance, if it was that's private information, you can't divulge it unless the second spouse says, I know my first spouse itemized, I have to itemize. Married filing separately disqualifies you from claiming earned income credit. It disqualifies you from receiving the credit for adoption expenses. It disqualifies you from claiming the credit for child and dependent care expense. Disqualifies you from deducting student loan interest paid. Disqualifies you from claiming education credits. Limits your capital loss deduction in half. So instead of being able to write off a $3,000 loss on a single or a joint return, you are limited to a $1,500 loss on the return, but the carryover still exists. What you can't use can carry over to future years, so it's just more of an inconvenience that you can't take as big a number as you could, but it doesn't limit the amount that you can actually roll over to future years. Some credits and deductions are reduced at income levels, half of those at a joint return, so meaning that my income can disqualify me for these certain credits faster. If you lived with your spouse at any time during the tax year, more of your Social Security or Railroad Retirement Tier 1's benefit will be taxable. That's something that we're going to talk about in the second part of today's lecture. Well, no, that's not today's lecture. I think it's tomorrow's lecture. But if you lived with your spouse at any time, one day, your Social Security will automatically be taxed at the maximum rate at married filing separately. Married filing separately, like we said, generates more tax than if you file a joint return because it increases at the single rate. It uses the single tax table, not the married tax table. You may figure your tax both ways and choose the filing status that produces the lesser amount of tax. You could do that. I mean, we used to have a program called LibTax that made our programs, so therefore that one was very good about you put all the information in all together and click a little button and it would automatically bring up, well, okay, married filing jointly is in one column, married filing separately is in the next two columns, his column, her column, and then you can compare all the numbers and see which was the best. Unfortunately, Fusion doesn't have that feature yet. I've submitted some articles to corporate about requesting things. They're working on adding other features as they go. That's just not something that I've seen that they've added yet. This is where a practice return comes in handy. Put them all, put all three together as a practice return. You're gonna make 3 returns, basically, but in practice mode, so it doesn't really count. And then you could choose which one gives you the best result. And if they agree, remember, it's married filing. If they agree on married filing jointly, they have to agree to do it. And if that's the way to go, then you could do that. But like I said, they could choose whichever gives them the best result. When we're doing married filing separately returns, we have to know the spouse's Social Security number. And we also identify the spouse's name down here in the filing status section if we're doing married filing separately. If we're doing married filing jointly, that name would appear up here. But for married filing separately, it's appearing down here. And again, we have to know the spouse's Social Security number. That way, when the IRS processes this return, they see this number down here for a spouse. Now they're going to be looking for the spouse's return and looking to see if they did married filing separately and what happened on those returns. If you live apart from your spouse and meet the certain tests, you may be qualified to consider unmarried. and we'll get into that. That's going to be under the head of household aspect of it. Filing status can be changed by filing an amended return using a 1040X. You can amend a married filing separate return to a married filing jointly return within 3 years from the due date of the separate returns, not including extensions. So if you filed married filing separately, maybe they were getting a divorce, they couldn't stand each other, but then they reconciled. Or, they got finished with the divorce, but since they were still married for that particular year, you know, bygones be bygones, they could go back and do a married filing jointly return, and then maybe qualify for some credits that they weren't qualified for before. They are totally within their rights to do that. But they have to do it within 3 years. This 3 years is an important number because if you are due a refund, the IRS only is required to actually pay out refunds for the 3 years, the current year included. So that's why this number is here. You could go back and file it for a previous year past this window, but it's not really going to help you. The IRS does not have to pay the refund after the 3-year window is closed. So, for instance, if you're for this year, obviously you can get a 24 refund, and then you can also get a 23 and a 22. But that's as far back as you can go. Once you file a joint return, though, you cannot choose to do married filing separately. So if you filed married filing jointly originally, there's no coming back with an amended return later saying, I want to do married filing separately. That's not allowed. You cannot do that. Community property states, doesn't matter if you're doing married filing jointly or married filing separately. At community property states, debt is considered to be owed by both of them, even if it was married filing separately. In these red states, it doesn't matter what one owes or owns, the other one owes or owns half of it. No questions asked in these states. And you can see that the states where our offices are based in, they are not community property states. Next filing status is head of household. To meet these, to file as head of household, you have to meet these 3 requirements. You have to be unmarried or be able to be considered unmarried as of the last day of the tax year. You have had to pay more than half of the cost of keeping up a home for the tax year. You have to have a qualifying person who lived with you in your home for more than half the tax year. That's a little strong. If you're supporting a parent, living at the rest home, living in assisted living, or living at their place, you can still do head of household, except for the considered unmarried. So if you're married but beat the test to be considered unmarried, the parent won't be the qualifying person under any circumstance. This is going to have to be a child. If you're unmarried for the whole tax year, on the last day you were either unmarried, divorced under a final decree of the last day of the tax year, or legally separated from your spouse under the divorce or separate maintenance decree. To file head of household, you also must have a qualifying person. In this case, a qualifying person is an unmarried child, including your child, stepchild, or eligible foster child. If the unmarried child is your qualifying child, he or she does not have to be listed as a dependent on your tax return to be your qualifying person. So if I sign an 8332 allowing somebody else to claim the dependency for this person, we mentioned before, head of household is one of those things that does not transfer. So even though there might not be a dependent listed in the dependent section, you still can do head of household. And if you recall, the section for filing status is where that line was, where we identified if we were doing married filing separately, where we identify the name of the spouse. That line is also used in this case. If we're doing head of household but we're not listing a dependent, the dependent that we would be using would be their name would be listed here on that line also. So that line is a double duty line for 2 different filing statuses. So, an example: Elise Taft, divorced, live all year with her daughter Megan. Elise pays all the household expenses for her and Megan. Megan's father is going to claim Megan as a dependent, so Megan's mother still may file head of household with Megan as a qualifying child. Elise would also check the head of household box on 1040, and since Megan would not be listed as a dependent, she enters Megan's name on the line at the end of the filing status section, just like I said. If for the This is the same line that we talked about earlier for head of household, or excuse me, for married filing separately. And like I said, Megan's not going to appear on the tax return down here as a dependent. That's why she's appearing up here. Now, if I have another dependent that would qualify me for head of household, and I signed any, if we kept this whole thing, but say that there was another child that Elise was supporting and living with, then I wouldn't have to fill this out. Megan's name wouldn't have to appear at this section. Wouldn't have to. In different circumstances, you might still want to. If Megan was very young, when it came to dependent care expenses, I would still have to list her here. If I was lower income and was qualifying for earned income credit, I would still have to list her name here so I could qualify for that credit too. Also, married child. This includes your child, stepchild, or eligible foster child. Must be your dependent. So what we talked about earlier when we were talking about joint return, when we had that military couple that I was talking about, the young military couple, where then the one deployed, the other one didn't make any sense for them to set up a house place, so they stayed living with mom and or with mom or dad in this case, since we're doing head of household as an example. The married child would still be a qualifying child based on the information that we talked about yesterday. So there must be your dependent to do head of household. There must be one of the related individuals in the qualifying relative tests to be dependent on your tax return. So Jared's 26, lived all year with his father while Jared went to school. His father pays all the household expenses, provides more than half of Jared's support. Jared is not his father's qualifying child because he's too old, but he still is his qualifying relative. In this case, they're also related. It's his son. Jared's father may use the head of household filing status. So like we said, he's aged out. He's a qualifying relative, not a qualifying child in this case, but we're still related. So you can't change this and say, well, it was, the girlfriend's daughter and the boyfriend's going to try and claim her for head of household. No, there's no relationship there. It's the girlfriend's daughter. Yes, she can be listed as dependent on the tax return, but since there's no actual relationship there, she can't be listed for head of household purposes. Any person who is a qualifying relative because they meet the member of the household test is not a qualifying person. So, like I said, a boyfriend or girlfriend or their children who lives with you does not qualify you to do head of household. The child of a boyfriend or girlfriend can be claimed as a qualifying relative for dependency purposes, but is not a qualifying person for head of household purposes. This person is going to file single in both of these situations, because that's the only option that's going to be available to them. Jack is single, supports his member as his household, his girlfriend Mary, Mary's 3-year-old daughter. Mary and her daughter lived all year with Jack. Mary has $19.15 wages and no other income. Mary does not have a filing requirement, did not file an income tax return. She has not signed the 8332 to allow her father of her daughter to claim the child. Mary meets the test to be Jack's qualifying relative, so he may claim her as a dependent on his tax return. Mary's daughter is not treated as a qualified child of Mary or any other taxpayer, so Jack may claim the child as his qualifying relative, providing that we've met all the other requirements. Jack will report 2 dependents on his tax return, but he cannot claim head of household filing status because neither Mary nor her daughter meets the relationship test. Jack does not have a qualifying person for head of household purposes. And of course, publication 17. Here we go. It has a table for you. Of course, they're going to have a table for everything, it seems like. So, This table is specifically asking who is a qualifying person for you to be able to file as head of household. Go through here, find out whether or not they meet the test to be considered. So these are the IRS guidelines, basically what we were just talking about. Parent does not have to live with the taxpayer, but they must be your dependent. And you must have paid more than half the cost of keeping up their main home for the entire year. Just remember yesterday's lecture. We talked about this in detail. And of course, the other thing we're going to mention, although this is going to probably be mentioned here shortly again, but I'm going to go ahead and mention it just to make sure. Temporary absences still count. So if they were away at college, as long as their home address is still going to be listed as your address, you're going to still qualify for head of household. Peggy's unmarried, maintains the home for herself and her daughter Kelly. This is the example. Kelly is a 20-year-old full-time student at Erie College. Kelly stayed in the dormitory all last year. She did come home to visit during term breaks. In this case, Kelly's absence from the home for educational purposes is considered temporary. Peggy can still do head of household as her filing status. And this would be true even if Kelly was renting an apartment up there. That would still be temporary. The dormitory is just a picture painter for you. It's not a requirement. They could be living at the sorority, the fraternity. They could be going in with roommates on an apartment. That's not, dormitory is not a requirement here. Head of household considered unmarried. This allows you to file head of household instead of married filing separately. This unlocks the credits that would be locked up if married filing separately. It's a better tax rate. It's a better tax rate than single, and it's a better tax rate than married filing separately. Still not a better tax rate than married filing jointly. It's a higher standard deduction compared to single people, and a higher standard deduction compared to married filing separately. But it's still not a good, better standard deduction than married filing jointly. Married filing jointly is still a higher standard deduction. To be considered unmarried, all of the following must apply. You file a separate return from your spouse. So you weren't going to do married filing jointly. You're going to file by yourself. You also must have paid more than half the cost of keeping up your home for you and any dependents that you're going to list on your tax return for the tax year. Your spouse did not live in your home at any time during the last 6 months of the tax year, and I stress any time. They moved out. They did not spend the night. This is the IRS. They make the rules, and if they spent the night, then they stayed at any time. So, if they stayed for Thanksgiving, they stayed for Christmas, that unfortunately disqualifies them to be considered unmarried. They can't spend the night, basically, any point after June 30th. Your home was the main home of your child, stepchild, or eligible foster child for more than half the year. Ruth and Joe were married, have not lived together since 2018. Ruth's mother, Paula, has lived with her all year. Ruth provides more than half the cost of keeping up the home, and she can claim Paula as a dependent. No one else lives in the home. Ruth cannot claim a head of household because she is married and cannot be considered unmarried. Her home is not the main home of her child, stepchild, or eligible foster child. Her mother is not a qualifying person to allow her to be considered unmarried. So they're married. If this was a child, yeah, sure, she could be considered unmarried filing head of household. But since it's her mother, even though she lived in the home, could be listed on the tax return as a dependent, since they're still married, can't do head of household considered unmarried. We don't have a qualifying person because we have to have a child. Either do married filing jointly or finish getting the divorce, whatever. So take care of the business. If you are married and do not qualify to be considered unmarried, you cannot file as head of household. You can only file as married filing jointly or married filing separately. Let's focus back on that 6-month rule again, because Brenda had a client, one of my tax preparers. She had a client where in previous years he was married. They filed jointly together. There was a dependent. she moved out. The client came in. Well, no, yeah, we haven't lived together. Uh, we live apart. You know, she has, on paper, he meets all the requirements to be filing head of household considered unmarried. Except that the IRS looked at the other person's tax return and saw the address. And the address was different, but it was still in the same block. So the IRS said, nope, you live too close together. You don't meet the requirements to file a head of household considered unmarried. They sent him a letter saying you're not allowed to file with that filing status. You must do married filing separately. By the way, you qualify for earned income credit. You qualified for a child tax, or you qualify for earned income credit. We want that money back. You're not entitled to it. Also, your tax rate went up, so here's your new tax number. Pay immediately. So there is a proximity factor to this that must be also considered. Unfortunately for Brenda, she tried to get some IRS agent to actually commit to how far distant must be. We know that the same block is not good enough, but no IRS agent would actually go on record with her saying how far was far enough. So we know the same block is not good enough. Therefore, I would venture to go ahead and say that the same apartment complex will also not be far enough. So do keep that in mind when we're doing head of household and considered unmarried, where the other spouse is. And if it's too close, you're looking at a potential IRS problem. When we're talking about head of household, one of the factors is the cost of keeping up the home. Costs that can be included are amounts paid for rent, mortgage, real estate taxes, home insurance, repairs to the house, utilities for the house. This one's specific, and so let's point this out. Food eaten in the home. So you don't get to count the costs of taking the kids out to McDonald's and eating at McDonald's. However, eating in the home, you do get to count the cost of going through the drive-thru at McDonald's and taking it home and eating at the dining room table. Okay, well, just be aware that if you're going to count food, make sure that it's stuff you bought from the grocery store or you had delivered to your house. So, if you're going to order Pizza Hut, if you have a hankering for a pizza, order from Pizza Hut, have it delivered. Don't go to the restaurant. That's going to count. Doesn't count against you, it just doesn't count for you. Costs that aren't included in keeping up the home: costs for clothing, education, medical treatment, vacations, life insurance, or transportation; the rental value of the home you own or the value of your services; the value of your services or those to a member of your household. So say like you're the, you're taking care of an elderly parent, you're providing services. Basically, you're the chauffeur. You're taking them to get their hair done. You're taking the medical appointments. You're going out and getting the shopping. You don't get to include the time value of that service that you're providing, which is interesting because if you think of some of the other things that we're talking about when we're talking about dependency, some of this stuff actually does count toward a dependent. A lot of this in here would actually count toward a dependent. We talked about this specifically. This would count toward a dependency claim, but neither one of these count to the cost of keeping up a home for head of household filing status. Again, the IRS has a handy-dandy worksheet for you, so if you need to determine whether or not you paid more than half the cost of keeping up the home, there's a worksheet that's available for you. Unfortunately, there's not one in the program, so you'd actually have to kind of work this out one yourself, either by going to this, printing this out, or just running your own spreadsheet real quick. Doesn't matter how you get there, but basically most of the time, just by looking at the situation, you can figure it out real quick of what's happened. This isn't as hard as it seems. We just have to cover it. For the sake of, yes, here's some information that can help you. Next filing status that we're going to talk about, qualified surviving spouse filing status. One advantage to the qualified surviving spouse over filing as a single person or filing as a head of household person is it has the same tax rate, uses the same tax table, and has the same standard deduction as married filing jointly. So there is an advantage to that. Ironically, the person that's in this picture probably wouldn't qualify for qualified surviving spouse, and we'll get to the reason why here in a second, but it's still possible, but not highly likely. To use qualified surviving spouse as your filing status, all of the following requirements must be met. You must have been entitled to file a joint tax return for the year the spouse passed away. So you're married. I mean, that's all. That's that one in a nutshell. You were married. Whether or not you'd ever filed jointly with them before is irrelevant. It's just for this year, could you have? Were you married? Yes or no? To do qualified surviving spouse, the spouse must have passed away in the previous 2 years, not including the current year that you're doing. So for this particular year, put this at 2024. So a qualified surviving spouse could only go back to 23 or 22. On 21 in this particular case, or for 21 or anything earlier than that, they cannot use qualified surviving spouse. It's been too long. They're either going to be single or they're going to be head of household. Qualified surviving spouse must have a child or stepchild who is their dependent or could claim as a dependent, except that the child had gross income of $4,700 or more, so that would be qualifying relative exclusion. The child filed a joint return or could be claimed as a dependent on someone else's return, or you could be claimed as a dependent on somebody else's return. Well, then obviously if you could be claimed as a dependent, there's no way you're going to qualify for a qualified surviving spouse because you have to support a dependent. Qualified surviving spouse, the child had lived in your home all year. Obviously temporary absences, though, do count to your advantage. So if they were away for medical, they were away for school, still counts. You paid over half the cost of keeping up a home that is the main home for you and the dependent child for the entire year. Well, that's not a new rule. That was the same rule that we just talked about on head of household. We're just recycling it here. Unqualified surviving spouse, death or birth, you may be eligible as a qualified widow or qualified surviving spouse. I prefer, this is the old term, qualified widow or widower. That's the old term. 2 years ago they changed it to this QSS. I like it better. It's just easier. So you may be eligible to file as a qualified surviving spouse if the child that qualifies you for this filing status is born or passed away during the year. We've already seen this rule before on the dependency lecture. It's the same one, so really nothing new here. So Jeff passed away in 21. Okay, we're going to move. I want to move this to 22 because if it was 21 now for this tax year, it's not going to work. But Jeff passed away in 22. He's survived by his wife, Sue, and his daughter, Tracy, who's now 22, and a full-time student. Sue is not remarried, keeps up a home for Tracy. For 2022, Sue filed with Jeff as married filing jointly. Even though he died, she could still do married filing jointly for that year. In 2023 and 2024, she may use qualified surviving spouse as her filing status, assuming that she can still claim Tracy as a dependent. If she cannot claim Tracy in either of the 2 years after Jeff's death, she must file as a single. If she remarries, she will be either married filing jointly with her new spouse or married filing separately with her new spouse. By the way, at this point, Jeff obviously has been dead for more than 1 year. He won't have to file a tax return because he wouldn't have any income. But let's talk about this one here real quick because there's a sentence up here that opens up an idea. If she cannot claim Tracy in either of the 2 years after Jeff's death, well, and that doesn't mean that she has to claim. Or if there was some reason 1 year she couldn't, but the next year that she could. So say like for the purposes of this example, in 22 she couldn't. For whatever reason, she was in such a wreck, she really couldn't support anybody. She moved back in with her parents, everybody lived there, she didn't work, whatever. But then in 23, she got her stuff together and went back on her own, provided support, can claim Tracy again. So, yes, we could do that. She's entitled to do that. You don't have to do it 2 years consecutive. There can be a gap if we need to. But remember, there's a hard deadline for it's the 2 years after. Can't go any farther than that. So value in selecting the best filing status, there is obviously value. When married filing jointly, it's generally the best for multiple reasons, because it has the lowest tax rate. It grows at the slowest rate on the tables. It has the highest standard deduction. Qualified surviving spouse, it's also the best because it's married filing jointly, just without the spouse, because they're deceased. Tax rate, again, is same as married filing jointly. The standard deduction rate is the same as married filing jointly. Head of household, better than single, not quite as good as married filing jointly. So there are many preferences available on head of household. Like we said, it's the better tax rate than single. It's a higher standard deduction than single. Single is only half the married filing standard deduction. Well, obviously, there's only half of you. And it's also lowered compared to head of household. The tax table increases at the fastest rate. And many deductions and credits are also reduced faster. That's a true statement. Married filing jointly, basically the numbers are double what the single are when we're talking about income phase-outs. Married filing separately is the worst. It's the least beneficial because it grows at the single rate, has the single standard deduction, and then, like we said, many deductions and credits are eliminated quickly or just not there at all. You can't use them just by rule. So some key ideas here. We have the single peoples. They are unmarried as of the last day of the year. It doesn't matter what they were the day before. It's just what they were on the last day of the year. Single people can also be legally separated under a separate maintenance decree. That means that paperwork's been filed with the court. It's gone through all the system. Everybody signed where they should have. The judge has approved it. Everything's done. Single people, that's the other thing that says, is if you can't figure out what to do with them, put them in this filing status. And there's a particular case on this. There's some times where somebody wants to try and do head of household. They're really entitled to do head of household. But it might cause some questions with the IRS when it comes to total support and some other things. It might be a red flag. And if their income was so low that the standard deduction rate would still cover their income, then go here. It causes less problems. It doesn't disqualify. It's not really going to affect them. They're not going to pay any more tax because the standard deduction still covered it. So we're not worried about that. And it just causes less. It's one less flag that we have to worry about. So there are been times where, you could have filed head of household, but really, given the entire picture of what we're looking at here, I'm going to file you as single because it's going to cause less. It's one less flag. You're still going to qualify for earned income credit. You're still going to qualify for child tax credit. It's not going to change any of that stuff. It's just, like I said, one less question. And I can do that. I can choose that filing status, and I have done that. Married filing jointly, you have to be married as of December 31st. You have to include both spouses' incomes, expenses, and deductions. Both must sign the tax return. Both parties are responsible for the payment of any taxes that are owed. Now, keep in mind, there's a couple of reliefs up here on the married filing jointly. I mentioned the innocent spouse. I'm going to mention the other one here in a second. Married filing separately. Again, you were still married as of the last day of the year, but you're only going to report your income. You do have to tell on the person who you are actually married to. And if either one of you itemizes on Schedule A, the other spouse must also itemize. Let's talk about a couple of things on this here because they're not talked about in the lecture and they're really not mentioned very well in any future things. So, number one, if somebody comes in and they say, I'm married filing separately, my first question is always going to be why? Why do you want to do married filing separately? Yes, there are certain situations where it's a good idea. There's certain situations where it's the only idea. I haven't seen him for a while. I can't find him to be able to sign, to file together. This is my only option. Okay, great. That's your only option. But if I hear the words, well, he owes student loan or something else, it's going to get recaptured. Don't do married filing separately. File an injured spouse. Do married filing jointly and file an injured spouse. Again, we know the debt benefits of doing that. Lower tax rate, eligibility for more credits, higher standard deductions. So everything's going to point to owing lower taxes and a bigger refund. And when you file an injured spouse, again, that's not something we're going to discuss in the scope of this class, but does get discussed in the basic class. When you marry filing separately, if there's a refund that's available, you split it out. You figure out, okay, this much of the refund is due to this spouse, this much of the refund is due to that spouse, and whichever spouse is the injured spouse is going to get their share of the refund. The form itself, you can fill it out assigning numbers to maximize refund, but at the end of the day, it's the IRS's rules. They can take your form as a suggestion and go with it, or just do what they want to do. So, like for instance, if I'm doing a blended marriage, and she had all the kids, but she's also going to be the injured spouse, I'll assign all of her kids to her, and that way the IRS has an idea that, well, if they qualify for child tax credits, all of the credits should actually be assigned to those children, and since they're her children, I want to make sure that she should get all of that refund. And I've seen the IRS actually accept that, so that's not an issue. But like I said, you can fill it out. You assign the income to each party, and again, you only have injured spouse if both of them have income and both of them have withholdings. Well, the second one's not as important, but both of them have to have income. And the refunds will also be allocated between a percentage of adjusted gross income of the two parties. So just look at that form sometime when you get a chance for injured spouse. The other thing that I want to talk about was if one spouse itemizes on schedule day, the other spouse must also itemize. On married filing separately, when both of them are married filing separately, that is a true statement. However, if the other party is going to do head of household considered unmarried, then this rule does not apply, because they're filing head of household, not married filing separately. Even though by any other scope they should have, but they can be considered unmarried for head of household purposes. So the first spouse who's married filing separately does itemize. The second spouse who is married or who is going to file head of household considered unmarried does not have to itemize. We have our head of household and our single people. They pay more than half of the household expenses, maintain a home for more than 6 months for an unmarried child. Remember, they don't have to be a dependent. We can sign it over. This includes grandchild, stepchild, adopted child, or eligible foster child. Can also be a married child, but still must be eligible to be claimed as a dependent. We've talked about the exceptions. The qualifying relative must be their dependent. A parent must be their dependent, but does not have to live with them for the head of household. The only time that this is not a true statement when we're looking at head of household is if we're doing considered unmarried. Then that one doesn't work. A qualifying relative who is not related to them but lived with them all year as a member of the household does not qualify you to file as head of household. There has to be a relationship aspect there. Head of household considered unmarried. Remember, you had to live apart from your spouse for the last 6 months of the year. You had to pay more than half the household costs for a dependent child, stepchild, or eligible foster child who lives with them for more than 6 months. There is an exception, though, for divorced or separated parents. A child is their only qualifying person. Like we said, the parent cannot be a qualifying person for head of household considered unmarried. Qualified surviving spouse must have a dependent child, must have paid over half the household expenses, must not have remarried, can use this status for 2 years after the death of the spouse. But really, you're going to be doing with a deceased spouse for 3 years, because that first year is going to be married filing jointly, and then the 2 years after that, qualified surviving spouse. All right, so that's chapter 1. We've gone through it at a pretty good pace. So um, that's kind of nice. Looks good for us to get done a little bit faster this morning. I'm sure everybody's going to appreciate that. So um, let's take about a 10-minute break or so. Try and get back here at about 10:15 to do the next chapter. Okay, welcome back from the break. We're going to talk about Chapter 4. We're going to actually move on to some actual information. I don't know. It's not like the other information is not useful. I mean, obviously it is. But now we're actually getting to start to build an actual tax return. By the time you actually get done with this chapter, you practically have everything you need to know to do the simplest of the simple tax returns. So we've continued to build on our information. I do want to point out that since we are live streaming on the YouTube section, this is the first time that I've really made an effort in this particular way. I mean, obviously you can look and see I've done this before in a kindly different separate format. That's a format that I have used for when I'm set up, and I have in-seat students. But today, since I'm again working out of my home office, I don't have an in-seat student, so I can do a screen share. You get a little bit more benefit of that. I do like this format better. I'm going to work on, maybe not for this particular class, but I'm going to work on getting my whole setup improved for future, so we could kind of go at it from this point of view. So we'll see who shows up next time I'm in seat, which hopefully is tomorrow. I'm planning on tomorrow being in the office. But one advantage to being in this particular format is that if you do have some questions, the live chat there on the right side is available. I can see it. I can respond to it if need to. So if you have questions, please go ahead, throw it in the chat. I mean, it adds to the discussion especially. But it just, it just makes it, I hate hearing my own voice. I'm sure you're not a big fan either. So, yeah, if you need to, if you want to, go ahead and ask some questions in there in this live chat. I can see it today. I can respond to it. We could talk about whatever we need to. So, and this goes, if you have a question over what we talked about earlier today, go ahead and throw it in that chat. We'll answer it. If you have some questions about what we talked about yesterday, please feel free to ask any questions in the chat. I will address those. And hold on, I got a chat from somebody that's actually at the office right now. Shannon went in. It's less of a deal for her. She lives a mile away from the office, and she wanted to brave it today. So, just a sec. She's asking if we had any ice melt at the office, and past couple years didn't really need it because it didn't snow in that direction, and we definitely didn't have the freezing rain before all the snow. And the landlord's actually been pretty good about cleaning it up, so wasn't really thinking about it, unfortunately. I might have to try and score some. Anyway, so back to chapter 4. Let's go ahead and get started here. We're going to talk about wages, salaries, tips, and other income, and some withheld taxes. Wages, salaries, pretty straightforward. I don't spend a lot of time on tips. I kind of go over that rather quickly. Mostly, like I said at an earlier time, a lot of most people are paying with credit card right now. The boss already knows what the tips are. I'll mention it. We'll talk about it a little bit, but I'm not going to go into a lot of detail on it. Things that we are going to cover today. We're going to talk about the forms W-2, a W-2C, a W-4, and a W-4V. I'm going to talk about the idea of taxable versus non-taxable income. We're also going to revisit the idea of earned income versus unearned income. We're going to talk about the Form 4852, which is a substitute W-2 or a substitute 1099-R. Again, we're going to talk a little bit about tip income in the Form 4070 and the 4137. Mention what a statutory employee is and some of the benefits that actually kind of go along with being a statutory employee. We're going to talk about the Form 1099-G in regards to unemployment compensation, but it also covers other things like taxable state and local income tax refunds. It goes even farther. I've seen it used for farm payments for setting land aside for non-farming. You're going to just say, I'm going to use it for pasture land, and then not do anything else with it. So I've seen that be paid out on 1099-G. But get used to the number 1099 because there's a whole alphabet that goes behind that. G is just the tip of the iceberg. I want to talk a little bit about Schedule 1 and the other income that goes along with it. We're going to talk about alimony and how that's changed in the past couple of years. And another thing that we're going to talk about is W2G, gambling winnings. We're going to mention the Form 1099-C and the Form 1099-NEC. We want to identify what's taxable income and what's not taxable income. We want to understand the difference between earned income and unearned income because that gets to be really important. They don't call it the earned income credit just because it sounds nice. There's actually a rule to it that involves earned income. Understand the taxability of tip income, reporting requirements, and how to treat allocated tips. Want to become familiar with the W-2, which hopefully you already have. Hopefully at least sometime in your life you received one. The more important one is this 4852, and what information is going to be reported on all of these. Learn what a taxable compensation is and where to report it on the tax return. Different boxes, different places. Understand the reporting requirements of the taxability of tip income, including allocated tips. Learn how to identify a statutory employee and report income on the return, which is pretty simple. There's a box on the W-2 that says statutory employee. That's how you can identify it. Understand what is considered non-taxable compensation and how it is reported. Learn what types of income are reported on 1099-G and how to report it on a tax return. Learn how to treat reimbursed medical expenses. Identify forms and other income and where those go. And that's just the tip of the iceberg. What income should you report? How do you report this income? I'm going to learn about employee wages, salaries, tips, other sources of income reported on a W-2. When preparing a tax return, you must identify what income to report, how much of it is taxable. Always treat all income as reportable and it belongs on a tax return until you find a good reason why you don't have to report it. And just because it's not taxable does not mean it does not have a place on a tax return. There are places on a 1040. If you look at it, there are boxes where you report non-taxable income. IRS Publication 525, Taxable and Non-Taxable Income, offers a comprehensive discussion of this subject. Taxable income must be reported on your tax return and is subject to tax. If you forget about it, the IRS will send you some correspondence later, and trust me, you don't want to have to deal with it, because not only are they going to tell you things that you probably don't want to know, don't want to hear, but they're also going to be penalizing you for not doing it sooner. So some common types of income, and again, here we have some examples of taxable income. Wages, salaries, bonuses, commissions, alimony, possibly. It's a detail. This has changed in the past few years. Annuities, awards, prizes, and rewards. Business and self-employment income, dividend and interest, farm income, gains on the sale of property or securities, gambling winnings, hobby income, pension and IRA distributions, rent, royalties, Social Security benefits may or may not, depending on other factors, tips and gratuities, unemployment compensations. It's just some of the things that are examples of taxable income. Some of the examples of non-taxable income, and looks like everything on here has no place on the tax return, So you would not use any, if you had child support, damages for physical injury, so like you received a court award, um, a lawsuit, you had a lawsuit and you won, dividends on life insurance, federal income tax refunds are not taxable, food stamps, gifts to a point. It's a big point, but for the most part, gifts are not taxable. This is kind of iffy. It should have an asterisk next to it. Inheritances are not taxable. Life insurance proceeds are not taxable. Qualified Medicare waiver payments are not taxable. Reverse mortgages, supplemental Social Security, supplemental Security income (SSI) not taxable. Veterans benefits aren't taxable. Welfare payments, including TANF, are not taxable. Workers' comp are not taxable, and none of these belong on a tax return. There's no box for them. I like seeing some of this. I like seeing some of these forms because they might help me prove some residency, like on child support. That helps a lot. I like having it. I might use it in my due diligence questions and cite this number if I have it available to me. It's like, okay, how did you support yourself? It's a due diligence question, and I will write down, as an answer, I'll write down, I received $500 a month in child support. Which the parent gets, the custodial parent gets to use as an example of support. Just because it's on this list over here doesn't mean it's not useful. It can be useful. So just don't ever take a look at a form and just wholeheartedly dismiss it. It's not usable. Think about what you're doing here, how it could be useful in some other places. And that's one thing that I strongly recommend. Client went through all the trouble to bring in this paperwork. Make sure that you look at all the paperwork. Even if you think it's not important, just go through the effort of looking through it. That way, the client will continue to bring in the paperwork. The last thing that you want is someone to bring in paperwork 1 year, you not use it, but you need it the next year, but they didn't bring it. Or they decided, well, he never looks at this type of stuff, so don't bring it. And that was the year that you actually needed it. So I always make an effort to look at all the papers that I possibly can, because I want to encourage the client to bring in all the papers they think are related to a tax return. I can decide later whether or not it's useful, but I want them to bring everything in the first go. I mean, nobody wants to go home for a second round. It's inconvenient to you. It's inconvenient to them. I just want to make sure that I encourage people to continue to bring their stuff. Earned income versus unearned income. Again, I mentioned this before in a previous one. Earned income, income received from work, such as wages and self-employment income. Unearned income is income produced from work, such as interest, dividends, most pensions, rental income, Social Security, unemployment compensation. All of this is the money's doing the work. Your investment's doing the work. You're not doing the work. This over here, earned income, you're doing the work. Right now what I'm doing, I'm going to get paid for it. This is earned income. I'm doing the work. Excuse me for a second here. I got a question I have to answer on a different channel for actual office stuff. Just bear with me for a second. All right. Income and taxes rules from IRS forums. The income that is generally still taxable even if the taxpayer does not receive a statement. This is true. Interest, dividend, interest or dividend income under $10. Bank pays you interest on your bank account. It's less than $10. They are not required to send you a 1099 INT. You are still required by the IRS to report that income. So I received $8 in interest for the year on my bank account. I have to report that income, that $8 on my tax form, even though that the bank is not going to be sending me a 1099 INT because it's under $10. Have wages and tips when an employer does not issue a W-2. Still have to report that as income. Contract and temporary jobs, this might be Schedule C stuff that we'll get into on the last day, but that's still income. This is also self-employment. These kind of all go together because a lot of the contract will be self-employment. Temporary jobs could be either W-2 work or self-employment. If you're working for a temp agency, for instance, they're going to issue you a W-2. You're going to treat it just like you would anything else. Just the fact that you only work there for a couple of days is irrelevant. It's income. You have to report it, and that's just good policy for the most part on all of it. If you're reporting if you make money by working or you make money through investing, it probably belongs on a tax return. Gross income, this is income received in the form of money, goods, property, and services that's not exempt from tax. We've said that before. And like I said, even if I perform some work and I got paid in eggs, I have to report that income. So I have to find what the fair market value of these eggs are and report that as income. Income from sources outside of the United States, as long as you're a United States citizen, it doesn't matter where in the world you make your money, you have to report it. You have to pay taxes on it. But on the positive side, if you already paid some sort of income tax to a foreign country, you get to use that as a non-refundable tax credit on this end. So there are advantages to that. But like I said, I have clients who live in Canada. I have clients who live in the United Arab Emirates. They are both working jobs in Canada, working jobs in the UAE. They are reporting income, even though they didn't get paid $1 US. They're still reporting their income. We have to convert it. I have to convert it from Canadian dollars to US dollars. I have to convert it from, I think it's dinars, to US dollars. But we still have to report it. Taxable income must be reported on your tax return and is subject to tax. Even income from illegal activities must be included. Think about that for a second. Excuse me, I got a little frog in the throat here. Coffee. Let's go back to this. Illegal activities. How did they get Capone? It wasn't over racketeering. It wasn't over bribery. It wasn't over murder. It wasn't over bootlegging. It was a tax evasion case. That's how they got Al Capone. He didn't report his income. I've mentioned Brenda in previous examples before. One time I believe she was working in a tax office in Virginia. Might have been Florida, but I think it was Virginia. Either way, she was doing a tax return. His job was to fly the snowbird. Snow in this case being cocaine. But he was reporting that income on his tax return because that's the last thing he wanted to get got for was tax evasion. To go the other way, and I'm not going to say this with 100% certainty, but the IRS is not really going to go fink on him. He's not breaking the law as far as the IRS is concerned. He's reporting their income. I mean, he's not being overly specific on what he's doing. He's just saying he's doing some illegal activities. But the IRS is really not going out of their way to share that information because he's being current on his taxes, and that's basically what they care about. This goes even farther. If you're a car thief, you need to report the fair market value of the car that you stole. If you're a jewel thief, say so on and so forth. So hopefully sometime in your life you received one of these, a W-2. Uh, Wages, salaries, tips all go into box 1 of the W-2. This is your gross pay, this box 1, um, before withholdings. This form must be sent out by the employer on or before January 31st. It must be postmarked no later than January 31st. This is going to be an important date when we talk about a different form coming up later, so keep this one in mind. Let's hear. Add the amounts from box 1 from each W-2 received and report the total amount of that on line 1A of your 1040. That's what the software is for. I mean, so when we're working with Fusion, it's nice. The form comes up on the screen. It asks for all this information. Line 1 is going to be box 1. Line 2 is going to be, it's really easy to follow along. Fusion's going to do all the math for you. It's going to do all the figuring. All you've got to do is put in this data entry. When we get down to it, for the most part, our job is pretty simple. We just do data entry. It helps to know it helps to know the rules, obviously. But at the end of the day, practically, we're just doing data entry. So if you're ever feeling overwhelmed about what we're talking about here in this format, we're going at a rapid pace. But still, don't feel like you can't do it, because like I said, at the end of the day, it's basically a data entry job with some other things on the side that we do have to account for, but in the core of it, it's really simple. So for an example, we have Lorenzo's salary. Its taxable was $35,000. His take-home pay is going to be $27,387.50 because his employer withheld $7,621.50 in taxes, well, Social Security, Medicare, and federal income taxes. So box 1 of his W-2 shows $35,000 as the report subject to tax, which Lorenzo must report on line 1 of his 1040. All right, let's see. Total tips reported to you by the employer. Regular pay in cash or the equivalent of cash will show up on a W-2. If the boss knows about it, the boss is responsible for putting it on your W-2. Bonuses and awards for outstanding work, whether in cash or in the form of goods or services. Yeah, that trip that somebody might have won to Florida for being the best salesman for the year, that's income. And fortunately, though, the boss is already going to report that as income. Something that might show up on a W-2, or that might show up as income on your paycheck, but will be excluded from income. Like, for instance, I'm about to buy some toner and some paper for our office. I'm going to pay for it out of my pocket. Then I'm going to send Brett the bill. Brett will reimburse me on my next paycheck. That's not taxable income because it's a straight reimbursement. He's going to pay me back exactly what I paid for it. So therefore, it's not income. It won't be reported in my W-2 at the end of the year, but I'm still going to get reimbursed through my paycheck. But like I said, that's not taxable compensation. That's just a reimbursement. Sick pay you receive from your employer, a welfare fund, a state sickness or disability fund, an employers association or employee paid insurance plan. That's all taxable compensation. And that would show up again on your W-2. Holiday gifts of cash or something easily exchanged for cash, such as a gift certificate, regardless of the amount involved, is income. You have to pay tax on it. You got a subscription to the Fruit of the Month Club. That's going to be income. You have to report that as income on your tax return. It should also already be included on your W-2. Get a severance pay when you get fired or leave your employment for whatever reason. That's income. You don't have to pay tax on it. Reimbursements from your employer for travel, transportation, or other business expenses, unless you're required to account for such expenses back to your employer, and return amounts over the accounted expenses back to your employer. Like I said, I'm going to buy paper, I'm going to buy toner for the office, I'm going to turn the bill into Brett. He's going to pay me back every penny, no more, no less. That's not taxable income. Now, if he says that here's a $500 expense account, which, by the way, given the price of toner, is not going to be enough, but just for our examples, here's a $500 expense account, and what you don't spend out of it, you get to keep. That's taxable income. What I don't spend, I have to still report that as taxable income. So that's what we're talking about here. So this is what we're saying. Basically, another way of looking at it, and this is a term that has been used in the past, accountable plan. If I have to account for my expenses and I get reimbursed based on my expenses, then I don't have to pay taxes on it. If I don't have to account for it, here's a spending account. Do whatever you want with it. I don't care. Keep what you don't spend. Buy lunch with it. That's not an accountable plan. I have to treat that as income. Employer-provided vehicles used for personal driving, commuting to and from work. Yeah, I've never seen anybody report this, unfortunately, although we know that this is income. But, if you drive the company truck, even for personal driving, help your friend move, or you move using the company truck, that's actually income. You didn't tear up your car, you teared up the boss's car. You probably didn't even pay for the gas. You probably just charged it the next time you filled up. That's income. Commuting to or from work, if you're using the company car, every day that I drive into work, I usually find myself near a Burlington Northern Santa Fe work truck with one guy in it. And I know he's not coming from the rail yard, and I know he's not coming down the railroad track. He's coming in from his house going into the rail yard. That's a commute. Technically, he should report those mileages as income. This is the W-2C that we were talking about, where in this case the C stands for corrections. I've never seen it in this particular format before. Normally it looks like just a normal W-2, but up here in this section there's usually a box that says, a check box that says corrected. And if there's a check in it, then we know it's a W-2C. That's a corrected form. So sometimes you might see this. You have two W-2s that look very similar. Which one do I use? Because they're from the same employee, or they're for the same employee, or they're from the same employer. What do I do? Look to see if one's a corrected W-2, and then go with the one that's marked corrected. Sometimes it comes out early. The employer figured out, oh yeah, by the way, we did something wrong. Here's a new form. Sometimes the mistake has to be found by the employee or the tax preparer. If you do, ask the employer to correct the employment record for name, Social Security, or address being incorrect, and file a W-2C with the Social Security Administration to report such corrections. I could go ahead and file a tax return without waiting on the W-2C in this particular situation. When we're talking about name, Social Security number, or addresses, I don't have to worry about that being particularly correct. At this point, I just put down what is the correct information. So like if it's an old address up here, we've got a new address, I don't have to worry about correcting it. Just point out to the employer if they're still working there, or to the taxpayer if they're still working at that place, hey, you need to go HR, tell them that you moved. That type of situation, that's not going to cause any problems for us to make that type of fix. However, if any of these numbers are wrong, we can't correct it at the desk. They've got to go back to their HR, their boss, and say, hey, this is wrong. Here's how it's wrong. I need a new W-2 issued, a corrected W-2. Because obviously, on the original W-2, where does one copy go? It goes to the IRS. And if you don't send in a tax form that represents those numbers that they know of, then they're going to issue a letter saying, hey, you did it wrong. Here's the corrections. It may be better. It may be worse. You don't want to go down that road. Get a W-2C because, again, on a W-2C, one of those copies is going to end up at the IRS. That way they can compare it to the tax return as filed with the W-2C that you had, see that these are the correct numbers, then you don't have to worry about getting a letter. And there's a reason why a lot of these letters don't go out until after June or later, because that's basically how long it takes the IRS to process all the W-2s and process all the corrections. So there is a lag time between that, so don't worry about, oh, I got a W-2C, it was just issued yesterday, should I sit on this for a while? No, you don't have to. The IRS is not really going to worry about any discrepancies that might have flagged in advance, because they wait until they're pretty certain that everybody should have gotten their W-2s in, and they've had a chance to process all the W-2s that they'd received, and like I said, typically that takes them until late May or early June before they go back and look, well, this W-2 doesn't match what was reported as a W-2 on that return, we're going to issue a letter. So we don't have to wait. If we have the W-2C, we know that eventually the two will meet up in the future and head off any potential IRS problems. So Corey has been employed by the Ace Insurance Company. Her salary was $29,000. She got a Christmas bonus of $500. She also won a sales contest in November. It was a 4-day vacation to Florida. The value of the vacation for airfare and hotel was $1,200. She didn't take the vacation until the following year. That's irrelevant. It's when she could have spent it, not when she actually did in this case. So this is going to be included on this year's W-2. So her employer reported her total compensation in box 1 of her W-2 as $30,700. That's the $29,000 of salary plus the $500 bonus plus the $1,200 prize. That's how you get to the 30,700. Now there may be some information in box 14 of the W-2 explaining how we got to the 30. That's informational. Box 14 of a W-2 sometimes has information on it that you need, sometimes has information on it that's just for information's sake. But go ahead on the computer and go ahead and put it in regardless, just for safety's sake, because sometimes what might not be used at the federal level does get used at the state level. So never ignore something that's on a form. Go ahead and put it on there if you know it to be a correct number, because like I said, you never know where it actually might turn up to be useful information. A substitute W-2, that's this form 4852 if you have not received your W-2s by the end of February. Remember, they're not required to be mailed until the end of January, and so therefore you have to give the Postal Service some time to process it. So if you have not received your W-2s by the end of February, and there's reasons for that. I mean, company went bankrupt. There's nobody there. Nobody's going to make a W-2, so you have to do this 4852. This is a substitute W-2 wage and tax statement. This form is also used as a replacement for a 1099-R that wasn't received. But like we said, you can't file a tax return with this information, with this form on it until the end of February. And it's not the best, because there's information that is helpful to file a tax return that doesn't appear. This 4852 is made by using paycheck stubs, the last paycheck stub. It's the best information that you have, but one of the pieces of information that does not appear on a paycheck stub is the employer identification number, and that's very necessary in the assistance of processing a tax return in a timely manner, especially electronically. It used to be that if I had a 4852, I couldn't even electronically file this form. It had to go paper because I had to send in a copy of that paycheck stub. The IRS had to have a physical copy because, keep in mind, with no W-2, they don't have any record of anything. So, all of a sudden you're going to be reporting income as a W-2 with this 4852, and they're not going to know anything about it. That's going to end up with some correspondence at best, some fines at worst. So this is basically your last resort. You want to exercise every available option to you. But like I said, if the company's no longer in existence, we're not going to get one. We know that. But we still have to wait, just in case. Tips or taxable income must be reported on 1040 line 1 whether or not they are included on your W-2. This includes cash received directly from customers, tips from charge cards that an employer pays to you, your share of any tips from a tip splitting arrangement. These last two most likely are already going to appear on the W-2. It's this cash one that, you know that. You left $5 tip on the table. And it gets even worse because we're going to find out that there's actually a threshold between the waitress having to report it to the boss or not. And here it is. You must report to each employer all tips you receive for each month. The tip amount is $20 or more. So that $5 tip, if it was just a $5 tip and that's the only tip I got, I don't have to report it to the boss. I still have to report it as income on my tax return, but I don't have to report it to the boss. If it's $20 or more, then I do have to say, hey boss, I got a $20 tip, I got $40 in tips, I got $100 in tips. You have to tell them. Do not report to the employer the value of non-cash tips. So like they give you tickets. Here's the tip. Go to the hockey game. But I still have to report that income, that value of the ticket, as taxable income when I do my taxes. If you participate in the tip splitting or tip pooling agreement, report only the tips you receive and retain. Again, that might already show up on a W-2. There's a box on a W-2 called allocated tips. It can possibly show up there. So, again, this is one of the reasons why I don't really stress over the fact that I obviously have a waitress in front of me, a waiter in front of me, because W-2s from a steakhouse. I know they're getting tips, but like I said, most of the time they're being processed as a card. And most of the time, the boss is already going to know about it. It's already going to be included in their W-2. Cash, check, and charge tips of $20 or more per month per place of employment are going to be subject to Social Security and Medicare tax. That's why that $20 threshold, and in any particular month, so that you're making sure that you're paying into your Social Security fund for hopefully when you get to retirement. If you have tips that weren't reported into your employer, you still enter all tips received as an adjustment on, you add them into box 1, or box 1, but here box 1C. If you're self-employed and receive tips, just include those as gross income. Don't worry about saying, well, this was gross income because of work that I did versus this is gross income I received as a tip. Just put it all into one category. It doesn't matter. Allocated tips. If your employer allocates tips to you, this is kind of like the tip jar. They're shown to you in Form W-2 Box 8. If they have not been included in Box 1 with wages and reported tips, allocated tips are tips that the employer has assigned to you in addition to the tips you reported to your employer for the year. Allocated tips must be reported on your tax return and is subject to income tax and Social Security and Medicare taxes. The amount in Box 8 for W-2 should be reported on 1C of a 1040 unless you can prove otherwise. That's why you should keep a tip log. And if they say that you received $100 in tips and you can prove that you only received $85, then you can change the number from Box 8 when you go to report it on Box 1C as received tips down from the 100 to the one that you can prove. That way, when the IRS actually sends out the letter saying, hey, there's a $25 discrepancy, prove it. You have your tip log. You send that back as proof. So Zach here works at Uncle Sam's restaurant as a waiter, keeps a daily tip record. He received only cash tips during the year. Every month his tips were $20 or more. Zach reported all his tips to his employer as required. All his tips will be recorded in boxes 1, 5, and 7 of his W-2. Income tax, also Security and Medicare taxes will be withheld by his employer, and that also will be reflected on his W-2. Daily tip records, you should journal as a waiter or as a waitress or somebody who received tips. You should journal your tips. Whether or not you report them, journal them. 4137 is the form. The IRS actually has a form for you to work with to keep track of your tips. Because like we said, especially if there's a discrepancy on box 8 between what you're reporting and what was reported to the IRS, they can request a copy of this completed tip record for verification that I didn't have to report it. It wasn't income. I didn't receive it. Report to each employer all tips you receive for each month. If you're participating in a tip splitting or tip pooling arrangement, report only the tips you receive and retain. Just because, if you're doing a tip pooling and you got a $20 check on or $20 cash on the table, you put it back in the pool and you get your share of it, and it happens to only be, $18. Well, then 18's your number. Do not report to your employer any portion of the tips you receive that you pass on to other employees because you didn't keep it. It's not your income. It's their income. They're the ones responsible for paying taxes on it. This statement here. Then if you receive it, then you have to report it. So, you just pass in the buck at that point. If your employer does not provide you with any way to report your tips, use 4070 to report your tips on your tax return. Like we said, here's our 4070. This is I got $20 in tips or more for the month. This is where you report all that information and turn it into the employer. Do not use the 4070. You should give your employer a statement that includes, so if you don't use the form, you can make a substitute form from scratch. Any tips you receive in the year that were reported to you by your employer as required after the end of the tax year but on or before January 10th of 2024 are not included in the wages in box 1 shown in your 23 tax return. So if they're not on your 23 tax return, don't record them on your 23. If they're not on your 23 W-2, don't add them into your 23 tax return. Wait until the next year. So Bob works for Tanya's beauty shop, made 18 grand. One month he made $32 in tips, another month he made 26. He reported those tips to his employer as required, and his employer included them in box 1, showing total compensation of $18,058. For the other 10 months, Bob made less than $20 in cash tips each month, so he was not required to report these tips to his employer. His daily tip showed total cash tips for the year of $175 that he did not report to his employer because they were less than $20 a month. Bob must enter the 1858 on line 1, and then 1C is going to have the $175. If the tips are $20 or more per month were not reported to your employer as required, the taxpayer must still pay the Social Security and Medicare taxes on those tips by filing a special form with your tax return. That's 4137. That way you get credit to your Social Security and your Medicare accounts that you did actually pay into it. A little bit now, potentially a better return for you later. Yeah, it sounds great to get paid under the table until you get ready to retire, and then you find out that it's going to come back and bite you because you're not going to get as big of Social Security payment as you could have had you reported that income when you first earned it. Your regular pay may not be enough for your employer to withhold all the taxes you owe. If this happens, you can give your employer the money until the close of the calendar year to pay the rest of the taxes. If you don't give your employer enough money, your employer will apply the regular pay and any money you give to the taxes in the following order. All taxes you pay on your regular pay, Social Security and Medicare, additional Medicare or rural retirement taxes on your reported tips, and then federal, state, and local income taxes on your reported tips. So that's where the money's going to disappear to in that order. File a 4137 with your tax return if you receive tip income above the $20 per month threshold per employer that was not reported to them, or your W-2 Box 8 shows any allocated to tip amount that you're going to adjust, especially. When Social Security and Medicare taxes are not withheld from your tips, you must pay the additional taxes with your tax return. So yeah, you could end up owing taxes, not based on your income, but based on your tips. Not based on your regular wages, I should say. It's still income, obviously. So here's an example of a filled out 4137 Java Cafe, the employer identification number, the total tips that you received, the total reported to the employer, so you can make up the difference, and then you find out, well, we're going to owe an extra $37 in this case in Social Security and Medicare taxes. So here's an example of a W-2 with basically a lot of the things that we have going on here. Hope Bradley reported $400 in tips to her employer. That's shown in box 7 of her W-2. Her employer reported the wages of $16,580 in box 1, which included the $400 of reported tips. Box 8 of her W-2 showed allocated tips of $484. The $16,580 must be reported on line 1A of the 1040, and the $484 on 1C. The 4137 must also be completed to calculate the Social Security and Medicare taxes owed on the allocated tips. Her W-2 and her completed 4137 are going to kind of look like this, based on this information over here. And there's some other information over here that we're not talking about, but this is Java Cafe, so we can see it's a continuation on from the example that we had on the previous screen. I'm going to point out a couple of things here because we're going to be visiting this stuff in a little bit. Box 13, this person is also participating in a retirement plan at work, and this is how much money has gone into the retirement plan. And like I said, we're going to come back and revisit this a little bit later. Back to the 4137. We've seen this one before. This is the same one that we just saw. So not only did she report the $400 into her employer, we also have to account for the $484 that she didn't, and that's here is happening here on this 4137. If you're a statutory employee, your income will be reported on W-2, and the statutory employee checkbox on box 13 of your W-2 will also be marked. Statutory employee are workers who are independent contractors under common law rules, but are treated by statute as employees. Statutory employees include full-time life insurance agents, certain home workers, and traveling salespeople. If you do not have unreimbursed expenses related to your income, enter box 1, 1040 line 1A wages. If you do have expenses that were not reimbursed by your employer, you can complete a Schedule C to expense those things. This is one of the few rare cases where somebody with a W-2 can actually currently write off work-related expenses. A statutory employee with expenses to deduct will not include their income on 1040 line 1A. That number is going to carry down to the Schedule C as gross receipts. And here's a preview of what a Schedule C looks like. We have a whole lecture devoted to this on the last day, so we're not going to go into a lot of detail. But this is where it's going to carry on to, and then we're going to go ahead and break down our expenses for what they were, just like we do in these categories, to come up with some net income. There are benefits that are reported on a W-2 that are not taxable, so they're either tax-free, like participation in a medical insurance program at work. Or they're tax deferred, like participating in a 401k. I'm not going to pay taxes on that income now. I'm going to pay taxes on it when I withdraw from my IRA at a future date. Income that is not taxable may have to be reported on the tax return, but is not included in the taxable amount. Like I said, the W-2 is going to have that information. The program is going to handle that information for you. Thank God for computers. Think about trying to do some of this stuff by pen and paper back in the day, Some examples of tax-free benefit is group health insurance paid for by an employer or with pre-tax income of the employee. That's going to show up on box 12 of your W-2 with the code double D. That income is not included in box 1. Doesn't show up on a tax return anywhere. Common forms of tax-deferred benefits are retirement plan contributions such as a 401k plan. Contributions made to a qualified retirement plan are not reported in the employee's income in the year the contributions made to these plans. The money is taxed in the year that is withdrawn from the plan. The amount contributed is known as deferred compensation, shown in box 12 of W-2 with a code D next to it. However, this compensation is subject to Social Security and Medicare taxes in the year that it's earned. So when we have this situation appearing, box 1 is going to be a lower number than boxes 3 and 5. And the difference between box 1 and boxes 3 and 5 should be the amount with the code D on the W-2, but down in box 12. If you see this and it doesn't match up, that is a flag for a fraudulent W-2. So here's an example of that going on. This is a legitimate one. Jack Spratt made $28,640. He participates in a 401k. He put in $1,400 of his salary. So we can see that box 1 is different than 3 and 5. And the difference between boxes 1 and 3 and 5 is this $1,400. And we also have this box 13 checked for the retirement plan. Let's talk about a couple of boxes on here in this section because they're not really covered well the way that I'd like to for future reference. So we can see here, yes, box 13 retirement plan is checked, and we can see that we're participating in it. But we can also have this box checked and have nothing over here, meaning that we were covered by retirement plan at work. We just didn't participate in the retirement plan at work if we don't have anything over here. That's actually important because when it comes to a certain credit, an adjustment to income that gets talked about in a future class, just because this box is checked changes some of the contribution levels. Even if we didn't participate, just the fact that we were covered changes some of the participation levels. The other box I come back and mention is this box here, statutory employee. We've already talked about that, but because this box is checked and we have some unreimbursed expenses, that means that we can unlock a Schedule C and report those expenses and drive down this taxable income to the point where even though taxes might have been withheld, it might have been too much, so we're going to be due a refund. Retirement contributions such as 401k are a common form of tax-deferred benefits. They're not included in income in the year the contribution is made, but are taxed when the funds are withdrawn from the plan. Excuse me a second. I have an office-related issue to attend. Should only take a second. It's here. The amount of 401k deferred compensation is shown in W2 box 12 with the code letter D. It doesn't have to be a 401k. This can also be other types of deferred compensation plans. It's something I believe that gets talked about tomorrow. There are other types of deferred compensation. The most popular, the most common is the 401k. But there are other things that could show up in box 12 with the code letter D that are appropriate. They're just not 401ks. So we're back to the Jack Sprat here, the 28640. He participates in the 401k, put in $1,400, and like we said, he's only being taxed on 27,240, not on 28,640. So his taxes are representing of that. And like we said, so when he withdraws this money from his 401k, that's when he's going to pay tax on it. Hopefully by then he'll be retired and be able to live on less income. So theoretically he might be in a lower tax bracket, although looking at this, he's in the 10% tax bracket now, so he's already at the lowest level currently. We'll see what it turns out when he actually retires. But unemployment compensation is taxable income. That's where a lot of people get in trouble. Unfortunately for them, they're not making any money, so because they're not working, so they're on unemployment. They're getting taxable income. They're not having taxes withheld. They're not going to be very happy when it comes to file their tax return because all of a sudden they're going to owe. So if you're getting unemployment, please make sure that you're having taxes withheld, or you're going to be very sorry next year. And unfortunately, you might still be in a position where you're not employed, so you really can't afford it. So pay me now, pay me later. At least if I pay me now, then I don't have to worry about not being able to pay it later, and then also being penalized for late payment, interest, and penalties. 1099-G is where this is going to be the form that's being reported on. Unemployment compensation per schedule for Form 1099-G goes to Schedule 1, Line 7. Schedule 1's got a lot of the other income stuff on it. Christopher and Natalie Williams, married, filed a joint return for the year, both laid off for the year. Christopher received $8,700 in unemployment compensation. Natalie received $12,006. They must include the entire $21,300 in their gross income for the year. I hope that they had money withheld, or they're potentially not going to be very happy. If the unemployment compensation they received was partially repaid, then you make an adjustment. If you repaid more than $3,000 of unemployment compensation that you included in gross income in an earlier year, you may be able to deduct it on Schedule A as another itemized deduction below. That's not going to help you a lot. Remember, to do Schedule A, you have to beat your standard deduction. If you're married filing jointly, your standard deduction is almost $30,000. That's a lot of deductions you got to come up with to be able to file Schedule A. So this again is if you're paying it back. I got paid for unemployment, and I shouldn't have, so I sent it back. But the W2 or the 1099-G still doesn't represent it, so we make the adjustment. So method 1, figure your tax for the year based on the amount of repayment, claiming an itemized deduction. Method 2, figure your tax for the year of the repayment, claiming a credit for the repaid amount following these steps. So figure your tax for the year of the repayment without deducting the repaid amount. Refigure your tax from the earlier year without including an income for the amount you repaid. Subtract the tax in 2 from the tax shown on your return for the earlier year. That's the credit. Subtract the answer from 3 from the tax for the year of the repayment. Figure without the deduction. We spend a lot of time talking about this. I have been doing taxes for over 2 decades. Never seen this. Don't worry about it a lot. But here it is in force for the example. Like I said, I'm not going to go into a lot of detail about this because it's very obscure. Does not happen very often. Here's something that can happen. Doesn't happen as much because of the Tax Cut and Jobs Act moved the standard deductions up to so high that it's actually hard to actually be able to deduct itemized deductions. So state or local income tax payments, issue a Form 1099-G. It looks the same. Box 2 is going to show the amount received, which is potentially taxable. Box 3 is going to show the refund tax year. Your state and local tax refunds will only be taxable or partially taxable if you deducted state and local income tax as an itemized deduction on Schedule A. So if I have a 1099-G, my first question to the client, if they're new to me, is, did you itemize last year? 90% of the time, somebody's going to look at me and say, what's that? Then I kind of already answered my question, no, you didn't. The other 5% is just going to be able to say, no, I didn't. And the remaining 5% is, yes, I did. Then you go and find out whether or not they deducted as an itemized deduction the state and local taxes paid. If they did, then the refund becomes taxable. If they didn't, if they deducted sales taxes instead, then the refund is still not taxable. For our offices, hardly anybody's going to be deducting sales tax because what they're going to be making in wages, what they're going to be paying out in state and local income taxes is going to be a better result. But say if you lived in Texas where there is no income tax, then they're not actually going to have to pay income tax on their tax refund because since there's no income tax, they didn't deduct it. So obviously it's not going to be taxable income to them. We'll revisit this again when we talk about Schedule A. Hopefully make it a little bit more sense. And the other thing is that even if I know that this is not going to be taxed, go ahead and enter the 1099-G into the computer. The computer will ignore it as necessary, but because there's a box I could check saying that this is not itemized deduction, did not use the local income tax or state and local income taxes, so it'll ignore it. But like I said, part of the thing is showing to the clients that I'm using their information that they brought to me. That way, if they happen to itemize in a future year, instead of, well, he never used this 1099-G, why should I take it now? They keep on bringing it because they keep on seeing I'm using it. And then that way, when I actually need it, I've got it. So Natalie's 42, got a 1099-G for her 2022 state refund of $325. She filed her 22 state tax income tax return and received a refund. Total itemized deductions for $7,200. Filing status was signaled. Therefore, rather than deducting $7,200 of itemized deductions, she deducted her $12,950 as a standard deduction for the 22 year. Since she did not receive a tax benefit deducting her 22 state income taxes, she does not have to report this $325 as taxable income. But like I said, I go ahead and enter it in Fusion anyway. Fusion will ignore it because there's a box I can check saying she didn't itemize last year, so it will ignore this. But like I said, Natalie saw me put it in. She's going to continue to bring me this form. If in the current tax year you receive reimbursements of medical expenses you deducted in a previous year on Schedule A, the reimbursement must be included in the current year's gross income. So what we're talking about here is that I was able to itemize. Part of my itemization was medical expenses. I went ahead and included some expenses on my Schedule A that I didn't think I was going to get a refund for or a reimbursement for from the medical insurance company. So I just went ahead and I used the itemized expenses, and lo and behold, next year they went and reimbursed me those expenses that I've already expensed out instead of having to file an amended return, although I could. That's not out of the question. It's not a wrong answer, but the easier answer is that Since there's a reimbursement of something I've already written off, I can include it as taxable income this year instead of having to file a 1040X for the previous year. Some other types of income that are included with wages are reported on line 1B through CZ. 1040 include household employee income not reported on W-2. 1040 line B. I'm not worried about this in the scope of our offices. Household employee is exactly that. This is the nanny, the butler, the maid. Those people have CPAs. They're not coming to us, but it's nice to know what it is. Medicaid waiver payments not reported on W-2 show up on 1040 line D. Another thing that there'll be a W-2 issued. This is related to it, but it's not the same. There'll be a W-2 issued for somebody who's providing care for a loved one at home. They're being paid for the state for providing this care. That's actually not taxable, but they do receive a W-2 for it. So you go ahead and report that as income, and then on a future line down in other income, you take it away. You put that same amount that was in box 1 as a negative number. There's a form, and I'm not going to remember the number specifically, but it's notice 2016-5 or something like that. That's not the number, just giving you the idea. They're explaining to the IRS why I've got this negative number and why I'm basically undoing a W-2. That way, I've reported the W-2. The IRS sees that I reported the W-2. There's no question about it. I'm not going to get rid of a letter for not reporting it because I explained what the reason why it's not being reported in taxable income on a other line by, I'm excluding it from income per IRS rule, that rule. Non-excludable dependent care benefits reported on box 10 of a W-2. Not really a problem that we have here out in the plains, but if you're working in a bigger city that was providing daycare in-house, or even reimbursing you or giving you an allotment so you can buy your own daycare, that can be excluded from income, and this is where it gets reported. Taxable employer provided adoption benefits, we're really not going to see that, so I'm not really caring about that. Disability pensions received before the retirement age, reported in box 1 of a W-2, report on line 1040, line 1H. Even though that's a disability pension, since I was getting it before I reached the minimum retirement age for my job, I actually get to report it as earned income. Pensions after that aren't earned income, but before retirement age are earned income. That can be important because it's going to make it eligible for earned income credit. Whereas after retirement age and disability payments are other income or unearned income, they don't help me and can for earned income credit. Non-taxable combat pay, this is our first mention of it. It gets reported on 1040 line 1I. Combat pay is exactly that. You're in the military, you're in a dangerous area, they give you extra pay for being there. It's not taxable. But there are certain situations, as we'll see as we continue on through this class, where I can elect to include non-taxable combat pay in the figuring of certain credits that might be able to help me out get more. And so we'll revisit this, but this is where I would be saying to the IRS that I'm going to include combat pay for helping me figure credits. It's not going to change the taxability of it. It's still going to get ignored, but this is where the IRS is going to find out why, how I got a different number than what they're seeing just based off of their line 1 income stuff. So this is the 1040 section of income, and we notice that we do have, let's see here. So this is not all of the things. I mean, obviously, we still have Schedule 1 to deal with, where we have other income that's not going to be... there's just so many options. You just can't put them all in the 1040. Remember, at one time, the whole goal of the 1040 was to get it down to the size of a postcard. and in 1 year they kind of almost got there. It was kind of more just exactly that. But the problem is what they did is all they did was cut and paste. They cut it off the original 1040 and then they just pasted it to another schedule. That's where schedules 1, 2, and 3 came from. Basically, all they did was just cut it off of the original 1040 and paste it there. So, yeah, they didn't really do much. Alimony or separate maintenance payments made under a court decree are taxable income to the person receiving them only if the decree was entered into before 2019. So if your client is receiving alimony off of the divorce that was put in place before 2019, it's taxable income to the recipient. It's also a adjustment to income down to the person who's paying it. I did have a client that did fall into this category. Anything after 2019 or 2019 and after, it's not taxable income. It doesn't get reported on the tax return as income. Also, it does not get the other side of it. It does not get reported as an adjustment of income to the person paying it. But if I have to report it, I report the taxable alimony received on line 2A of Schedule 1. I also enter the date of the divorce decree on line 2B, showing the IRS that, yes, this is taxable income. It should be reported as taxable income. And this is the date that the divorce was put into place, proving to the IRS that I have followed the rules. So, one to receive alimony payments of $250 a month, she reports the $3,000. That's the $250 a month times 12 on line 1A of line 2A of Schedule 1, and like we said on 2B, reporting the year that it was put in place. This decree went into place in 2018, so she has to report this as income received, and her ex-husband is reporting this $3,000 on his, I believe it's Schedule 2, further down on his Schedule 1. There's a line for alimony paid. And he's going to write down $3,000, and he's going to write down the Social Security number of the person he paid it to. So that way the IRS can track it down and make sure that she reported it as income. Alimony or separate maintenance payments made under the court. We already said that. Why did it go backwards? Okay, interesting. If the taxpayer paid amounts that are considered taxable alimony payments to the recipient, deduct them on Schedule 1, Part 2, just like I said. Like I said, we're going to think on the person that's receiving it. And we're also writing down the date that it went into play. Child support payments are not now or never were alimony. Do not deduct them as an adjustment down. Do not include them as income in. Ever. Doesn't matter what year it was placed. Child support is and was never deductible and is and was not considered income. Additionally, if a divorce or separate maintenance instrument provides for alimony and child support, and the payer's spouse pays less than the total required, the payments applied to the child support first. Only the remaining amount is considered alimony, and you're not going to have a great record on this. This is not necessarily coming as a W-2 or a 1099 or anything like that. Basically, you're kind of working off bank statements at that point. If the taxpayer is receiving child support payments, do not include them as income. Just a second. Bear with me for a second here. So James paid Wanda alimony payments of $250 a month. This is continuing on our example that we just talked about. He reports the deduction as an adjustment, Schedule 1, Part 2, line 19A, and her Social Security number on line 19. So here we go. This is all the information we just talked about. The $3,000 he paid out, who he paid it to, when the decree went into effect, showing that he is indeed eligible to write this off as an adjustment to income. So he's going to pay taxes on $3,000 less income. Now, it can benefit him for paying out alimony. This chart here basically more or less the IRS is telling you what counts as alimony, what wouldn't be alimony before 2019. And remember, 2019 or after doesn't matter. Alimony or child support, either way, don't care. It's not income in, and it's not an adjustment out. So we talked about some Schedule 1. So here's the entire Part 1 of Schedule 1. This is income that's going to be reported as taxable income, or maybe, like we said, other income down here. This is where I'd be undoing some income, for instance. Another thing that I use that we're not going to talk about in the scope of this class, but I would have another thing that would be down here that would be a negative number that I use is foreign employer compensation. Able to write off some expenses for foreign housing, so I get to use the negative number down here to offset some of their foreign income being reported. But so let's talk about some of these lines. Schedule 1, line 8 is used for taxable income that does not belong anywhere else on a tax return. If you can't figure out where to put it, if there's not a schedule for it, if there's not a form for it, it lives here. So prizes and awards, exactly just that. You go on the Price is Right, you win something. Let's hope it's cash, because you're going to pay tax on it. You're going to need it. If you get a new car, you're going to pay tax on that too, so you better figure out a way to pony up the cash, because it's going to be showing up on your tax return. Gambling winnings. You go to the casino, you get a W2G, which is something we're going to talk about. It's going to go here in this section, but even if I buy a $5, buy a scratcher and I won $5, technically that's income. It's gambling winnings for my $5 lottery scratcher, so I should report that as income on my tax return. Unfortunate enough to go serve on a jury, I get paid for it. Adding insult to injury, that's taxable income. I have to report it. Alaska Permanent Fund dividends, obviously not much of a problem around here, but basically what this is, it's income paid by the state of Alaska to Alaska residents. It's their share of oil revenues. Non-business debt cancellation is income, and this is a 1099-C, so this is something that we'll talk about here in a little bit, so I'll save it for that time. Add a description in the spaces provided. This is really specifically talking down here on line Z. The fair market value of prizes and awards generally taxable must be reported on line 1, Schedule 8, or Schedule 1, line 8. So we're talking about in this area right here. If you give the pay to your employer because the employer paid you your salary while you served on jury, deduct it back out. So you're going to show that you received jury duty pay, but since you paid it back to the boss because he kept on paying you your regular wages, you get to subtract it away. So yes, you show the IRS, I acknowledge receiving it because you know about it, but I'm going to subtract it away, and here's the reason why. Alaska Permanent Fund dividends, they're not actual dividends, but they are reported on Schedule 1 as income. Non-employee compensation is money you pay individuals who aren't employees in your business but who contribute work or expertise to your business. Example, independent contractors, consultants, and people who work for subcontractors and some temp agencies. A lot of temp agencies are actually issuing W-2s, so this is less of a thing, but these other ones, very common. Do not report on line 8Z any non-employee compensation shown on a 1040 Form 1099 NEC unless you know for sure it is not self-employment income, such as income from a hobby or sporadic activity. I'm going to kind of save this for a while, but yeah, this can be hobby income, or it could go to Schedule C. Like I said, I'm going to save this for a while because one of the things that when we're talking about hobby income is not earned income. Schedule C net income is earned income. But one of the things about being on a Schedule C is that you're behaving in a business-like manner, and there are certain people that are doing shady things to try and claim earned income credit, and so they do self-employment. They kind of pad the numbers up a little bit to help them out, but I work my way around that. If I know it's shady, if I can't get enough documentation for my satisfaction that you are behaving in a business-like manner, I can then say it's hobby income instead. That way I am reporting the income. You will pay income tax on it, but it's not going to help you on your earned income credit. Therefore, I've also exercised my due diligence and taken some of the heat off me. But like I said, that's a last resort. That's not something I'm looked to do first. It's one of the things I look to do last. I don't want to do that, but sometimes I'm forced to do that. We'll revisit this later. This is what a Form 1099 NEC looks like. It used to be this was reported non-employee compensation is what the NEC obviously stands for. But this is a relatively new form. Up until a couple years ago, non-employee compensation was, and it actually still is, Box 7 on a 1099 miscellaneous. And it's not wrong to have a 1099 miscellaneous with a number in Box 7 as non-employee compensation. It's not a wrong answer. It's just that the better answer by the person issuing it, so this is not an us problem. We don't make these. We only report them on a tax return. We don't make them. But the better answer, the more proper form currently is this 1099 NEC, reporting non-employee compensation. And basically when you see one of these, that's the only number you're going to basically see. It's going to be up here. The payer's name, so who paid the money, their tax identification number. It could be a social security number. It could be an employer identification number. Who the tax identification number of who received it and who receives this name. Obviously, it's going to be your taxpayer or the spouse of your taxpayer showing up in here, and with a number here. These numbers are hardly ever used. Nobody withholds taxes on contractors. It's their responsibility, basically, to do quarterlies. Gambling winnings. These include, but are not limited to, lotteries, raffles, horse and dog races, casinos, as well as the fair market value of prices such as cars, houses, trips, or other non-cash prizes that you might win, especially in the lottery or on a raffle or something like that. Note that the cost of a raffle ticket is not a charitable contribution. It's not a donation. You haven't, not that you expect to win, because obviously the odds might not be that great for you, but you do have some expectation of being reimbursed, so it's not a donation. No matter how much you actually paid for the ticket, it's still not a donation, but it can be a gambling loss, which you can write off. A little preview of Schedule A, I can write off my gambling losses up to the extent of my gambling winnings. So if I spent $5,000 and won $3,000, I report $3,000 income, and I can write off $3,000 of losses, obviously that I can prove. The fact that I lost $5,000 is irrelevant because I only lost $3,000, so I've done all that I could. And again, that little thing is going to be something we'll talk about again on Schedule A. If you receive $600 or more in gambling winnings, the payer, the casino, is required to issue a W-2G for gambling winnings. Obviously, the G standing for gambling. Minimum recording requirements differ based on the type of gambling that was involved. So $1,200 for winning at the slot machine or the bingo game, $1,500 from winning at a Keno game, $5,000 from winning a poker tournament. That causes automatically a W-2G to be reported. This is an event-driven form. There's not one W-2G that's issued at the end of the year by the casino. Every time that you win this number or more from a slot machine, you get a W-2G. Every time you win $5,000 or more from a poker tournament in a year, you get a W-2G. Even if from the same casino, like I said, it's an event-driven thing. No losses can be deducted on Schedule 1. They're reported and is deducted as other itemized deductions on Schedule A. The amount you can deduct is no more than the amount of your gambling winnings that are being reported on Schedule 1, Line 8B. Fusion's pretty good about this. I could put in the big number, the $5,000 that I talked about earlier, and it will only apply the $3,000 because it's going to go back and reference this line here to see what the limit is and then cap it at that point. So you could cap it yourself, you could let the computer cap it, whichever makes you happy. But this is one of those places, and I haven't mentioned this at this point, but this is one of those places where there's this guy. His name is Some Guy. Some Guy told me this. Some guy I'd like to just take aside one day and beat with a baseball bat. Because some guy usually has a kernel of correct information surrounded by a lot of misinformation or missing information. In this particular case, some guy is going to provide missing information. Some guy is going to say, hey, you know those gambling losses that you had? You can write them off. And that's as far as it goes. So they come in with their big winnings on their W-2s and say, well, I was told I could write them off. So they think that, okay, I won $5,000. I can prove I lost $5,000. I shouldn't owe any taxes on this. Wrong. It's not that simple. It's not a dollar for dollar deduction. You take it to Schedule A, and you can write it, and you can put down it. And if they can file a Schedule A, yes, we are deducting some of their taxable income overall, but obviously past the amount of a standard deduction. But if you can't even file a Schedule A, say if the $5,000 was your only deduction, it's not going to help you. And so you're going to pay tax on all of your winnings. And I've had more than one client be upset because it didn't work out the way they thought it should, because some guy gave them a piece of information, but unfortunately they didn't give them all the correct information. And so now all of a sudden they owe a big deal of money where they didn't think they would, because, like I said, some guy said, well, I can write off my losses. Well, in and of itself, the statement is a true statement. There was no lie here. It was a true statement. It was the details that was missing. So Donna won $7,500 from her state lottery. It was reported on her W-2G. She reports $7,500 on line 8B of Schedule 1. Any losses that she has for the year, she report on line 16 of her Schedule A, but she may not report more than $7,500 in losses. If Donna does not itemize deductions, but rather takes her standard deductions, she will still report her $7,500 of winnings, but will not receive any tax benefit from her losses. Certain types of gambling winnings are subject to mandatory withholding. Winnings of more than $5,000, 24% is going to be withheld, and it's going to be represented on the W-2G as federal income taxes withheld. Just like anything else, that's actually a good thing. If the winnings exceed $5,000, the entire amount won is subject to withholding. W-2G shows the date and type of wager as well as the amount of the winnings and any withholdings that were withheld. The amount will be shown on box 4. Add this amount to any other withholdings, like from your W-2s or your 1099s. The computer's going to take care of that for you. So here's an example of a W-2G. We have a lot of information going on here. We have who's paying it. In this case, the payer is the New Mexico State Lottery. So this guy won a lottery transaction. So we see that here on the type of wager. He won lottery. We have the information of the winner, the date that he won it, how much he won. The fact is that especially since this is from the state lottery, they're more likely to withhold taxes, and they did so here. I'm somewhat surprised they didn't withhold state tax, giving us the state lottery, but at least they did withhold federal taxes. And so he's going to get a $2,053 credit on his taxes that he's already paid, and he's going to report the $8,555 as winnings. So the example, guy's tax 1040 shows 4,240. Box 2 of guy's W2 shows 2,568. Withheld in taxes from the wages he earned as a job as an auto mechanic. Guy also had gambling winnings, which he reported on 8B, Schedule 1, which is this W2G showing winnings of $8,555 from a lottery ticket. Box 4 of the W2G shows that tax was withheld of $2,053. Guy adds the $253 to the $2,568 that was on his regular W2, and enters the total of $4,621 of taxes withheld on his Form 1040. I'm going to point this out that this is a state issue. The state lotteries issue it. They're more likely to withhold taxes. In Kansas, just down the street down here, down the turnpike a little bit, at Mulvane, is the Kansas Star Casino. It's run by the Kansas Lottery. They're more likely to withhold income taxes. If you go to the Indian Casino, whatever it is, wherever it's at, they're not required to do that. Tribal casinos are not required to withhold taxes, and they don't. And so, therefore, these numbers are most likely going to be blank. Don't be surprised about it. They're not required to do it. They're not going to do it because, again, the tribals have a little bit more say on what they can do with what happens at their casinos. Don't forget, it's also pointed from the point of view, it's not as big an issue as it used to be for us here in Wichita, but if you go down to Oklahoma and win there at their casino, you have Oklahoma income. Don't forget, you're also going to be required to do an Oklahoma return. And that's true of any income that you have that's out of state. If you go make some money in another state, you have income in that state, you must report income taxes to that state. You must file a state tax return for that state, your state, so it can get sloppy. This is the saddest happy form you'll ever see. 1099-C. If the non-business debt that you owe is canceled or forgiven, the canceled amount is now going to be considered taxable and must be included as other income, line Schedule 1. If the debt canceled is more than $600, you should receive a 1099-C. If no form is received at all amounts of canceled debt, even those less than $600, are still considered taxable income. You must report them. Even though that the IRS doesn't know about this. Like I said, this is the happiest sad form that you'll ever see. Sorry. So let's go back to this. Let's talk about this form in and of itself. Our real life example in this, the client came in. She was very happy because she was just told toward the end of the year that the bank that was holding her mortgage decided that they were going to cancel her mortgage and just leave her with the house. I don't know what the circumstances were behind that decision, not relevant to the example. But she was a very happy person. She doesn't owe the bank anymore, and she owns her house free and clear. Very happy. The bank issues this 1099-C. Client doesn't know what it is, so she comes in. She's still happy. We see it wasn't me doing the tax return, but obviously this story gets around. I was in the office at the time. Client plops down this 1099-C in front of the tax preparer, put it into the computer. We now know by rule that this is going to be taxable income. She was forgiven, I believe the number was like 40,000, might have been 60,000. The number's not exactly relevant. It was a big number that she was forgiven. She thought she was happy. She doesn't owe it anymore. Well, when you throw it into taxable income, now she owes the IRS income tax on that, and so she exchanged one debt amount to the bank for another debt amount to the IRS. She was no longer happy. She was leaving the office in tears because now she owes the IRS a boatload of money. And unfortunately, there's not much we can do about it. There are certain things that we can do. There's a point where we can try and prove some insolvency. If you could prove that you were basically broke at the time that this was issued, that takes away some of the sting. But there's a lot of hoops that you got to jump through. I've filled out that form before. That form is very detailed. It's going to ask a lot of questions like the value of the clothes in your closet, the value of your silverware, what's in the jewelry box. It's going to ask all of those questions to prove whether or not you were actually insolvent. If you were, then, like I said, some of this or all of it can be forgiven. If you actually were solvent, yeah, you're going to pay tax on this. And like I said, our client, unfortunately, and it was nothing that we did. She was not sad at us. She was not mad at us. She understood what was happening. My preparer was one of my ace preparers. I'm fortunate to still have her. She was an ace preparer. She still is an ace preparer. Explained it thoroughly. The client understood what happened to her. But like we see, it was a happy event, seemingly, until we find out what exactly happened and how the repercussions came about. She wasn't so happy anymore. So, like I said, that's a cancellation of debt. You owed something. Now you don't. The IRS considers it income. It could be a mortgage. It could be your credit card bill. I've seen this in examples before. My example that I actually used, it was the Harley Davidson dealership over a motorcycle. But I've seen this from Capital One for credit cards. Just it could come from any place. It could be over anything. But just keep in mind the principle behind it is that you had a debt you no longer owe. It was forgiven, so the IRS is now going to treat it as income. You're going to pay income tax on it. Income tax, well, we talked about, is a pay-as-you-earn system. You're required to pay 90% of your taxes throughout the year. If you owe more than 90% on April 15th, you're going to be subject to an underpayment penalty. Withheld taxes are payments withheld from your income submitted to the IRS for the benefit of meeting that 90% threshold. That's also the idea behind quarterlies. If you work for yourself, you're going to have net income, and you know it, you should pay quarterlies to meet this 90% threshold, because if you do not, you're going to be subject to an underpayment penalty. As an employee, your employer withholds the taxes from your pay. Federal income tax is taken out of your wages, shown on box 2 of your W-2. Report the total amount of federal income taxes withheld and paid on line 1040 and line 25A currently. Only enter the amount of box 2. You don't get to take off what was entered, what you paid in taxes and for Medicare or Social Security in boxes 4 or 6. Sorry, you get that benefit later, hopefully when you retire. So box 2 of your W-2, this is no, and you don't have to have a number here, by the way. You can have income. There are people that have set up their W-4 knowing that they're going to have low income, other credits that are going to cover what they would owe in tax or not owe any taxes. So they don't have to have taxes withheld. You're not going to see that very often, but I'm just going to say it now, is that there's not a mandatory amount that has to go in here. This can be 0 and still be a legitimate W-2. If you work for more than one employer during the year, add them all box 2s from your W-2s together. It's also box 2 on your 1099-R. No, it's not. A different box number there. And we'll discuss that later. But, well, actually it has its own line anyway. But, so add up all your W-2s, your W-2Gs, your W-2Cs. They go on this line right here, as this is a tax credit. You've paid it. This is, it shows that it was a payment that you've made, so it's a tax credit to help you pay off your taxes. Hopefully it's going to help you generate a refund. Richard worked for 3 jobs, received 3 W-2s. The amount shown in box 2 of each W-2 enters the total of all of those on 25A of their 1040. Like I said, the computer does that for you. And what's in W-2 Box 2 is based on what's filled out when you start working for somebody, this W-4. How much you want withheld, this is the new form. Well, new-ish. It's been around for a while. I hate it. I do not like this form. I like the other form. A lot of people are getting in trouble. They're not having enough withheld. And then all of a sudden they owe a lot of money at the time they do their taxes because they misunderstood something, because it's kind of murky. It's not the best worded form in the world. And so they're not having enough withheld. And if you do find that out, you look at it, hey, you made $20,000 and you only had $50 withheld. Yeah, there's something wrong with your W-4. You need to go file a new one. By the way, you're going to owe a lot of taxes this year. So that's based on this. We, as tax preparers, do not fill out the W-4 for somebody else. We can advise them. We do not fill it out. Do not fill this out for somebody else. We're not opening ourselves up to that. We will walk them through it. We'll help them make decisions. We do not fill it out. W-4s must be completed when starting a new job. I almost kind of wish that this was required every year, that you fill out a W-4. And you can fill out a W-4 as a replacement as any time that you want. So, and some people do this. They know that Christmas time they're going to get a big bonus. They want extra withholdings, so they fill out a new W-4. So extra withholdings are taken out of the bonus, the big bonus that they're going to get. And then as soon as they get that bonus and have it taken out, they file another W-4 going back to the way it was. I've seen it. I've actually done it a couple of times. And like I said, you can fill out as many W-4s and submit them to HR as you want. They have to put them in place as soon as they get them. But like I said, I almost wish that this was a requirement to be refilled out every year. And keep in mind that if you see a client that has under withheld based on what their W-4 says, and it's already March, and you tell them that, well, hey, you need to file a new W-4 because you're under withholding big time. Hey, it's already March. They're already 3 months into the year. They're already under withholding for 3 months, almost a quarter of the year. They might need to consider having extra withholdings that they could do here on this form, or maybe sending in a quarterly payment so they don't owe so much, or set themselves up for maybe even a small refund. Like I said, we could do voluntary withholding. That's another option. So like instead of filling out the W-4, I go ahead and take my big bonus, and I decide that instead of having the boss withheld for it, I'm just going to go ahead and hold it myself. I can fill this out as a temporary thing. Form W-4V, fill this out for unemployment compensation because there's no requirement for withholdings on unemployment. There is a requirement. You have to fill out a W-4 when you get a job. There's a requirement. You have to fill it out. There's no requirement for unemployment compensation. This is voluntary. There's no requirement to fill out a W-4 for Social Security benefits. That's voluntary. Some people need to and do. That's how they pay their taxes. Because they have other income in other places, and instead of paying quarterlies, they decide that they have their taxes withheld from their Social Security benefits. They can do that. That's an option. Social Security equivalent Tier 1 railroad retirement benefits. We haven't talked about that yet, but basically read this as Social Security benefits for people who worked on the railroad. Commodity Credit Corporation loans, certain crop disaster payments. You can have these are farm things. You can have taxes withheld. Dividends and other distributions from Alaska Native corporations to its shareholders. You can have voluntary withholdings for it if it's going to be big numbers. For unemployment compensation, the payer is permitted to withhold 10%. Some is better than none. Trust me. For other payments, you may choose to have the payer withhold federal income 7, 10, 12, or 22% from each payment, but no other percentage amount. And you can't put in a custom amount on these W-4Vs. You can put in custom amounts on the W-4 itself. I do that. My wife, she works for the school district. retirement plan she's participating in is Capers. The state taxes Capers as it goes in. That way, when it gets distributed, the state doesn't tax it when it comes out. But that means that usually we've under withheld at the state side. So we usually owe about $100, $150 a year. So I just have a little extra withheld from my paychecks to help cover that, so I don't have to write a check at the end of the year to the state of Kansas. Now keep in mind, I'm not having a lot withheld. I'm not aiming to get a big refund from the state. That's stupid. They're keeping my money and not paying me my interest on money that I'm telling them to withhold. I'm just trying to make the $100 go away. I'm not trying to get a $5,000 refund. That's silly. I don't want to do that. Sometimes, and let's talk about that elephant in the room right now. Refunds are nice, but if you're getting a big refund based on your withholdings and no other tax credits, you're kind of silly. You're having a lot of money withheld that you get paid to in April. That's great. Maybe some people do use that as a reinforced savings account, but in the meantime, the IRS was holding your money that you didn't need them to have, and they're not paying you any interest on it. That's not the best plan. Now, I can understand getting a big refund because you qualified for a big refundable credits. You have no control over that. You can't get it paid to you early. But if you're getting a big refund based on your withholdings, reconsider your position. You're kind of being a little silly. All right, so for key ideas here for the chapter as we wrap it up, the total of all taxable compensation earned as an employee is entered on 1040 line 1. Taxable employee compensation includes salary and wages plus payments given in the form of bonuses, awards, strike benefits, and severance pay. All tip income is subject to income tax. Tip income that was not reported to the employer plus allocated tips, but W-2 Box 8, must be reported 1040 lines 1C. If you maintain a tip record and can prove the total amount of tips you did receive, you will not have to pay income tax and Social Security and Medicare tax on tips allocated to you. In Box 8 of your W-2, you must keep the tip record for verification, as the IRS may request a copy of it. That's just true of just about anything that you're going to use to show the IRS that I don't owe as much tax. I shouldn't be taxed on this amount of money. You have to back it up. That's just true of just about anything. 4137 is used to determine Social Security and Medicare taxes due on unreported tip income and allocated tips. Other income that must be reported on 1040 line 1 includes the taxable portion of scholarships and fellowships, which we didn't talk about. Well, basically, if I'm receiving a scholarship, it generally is tax-free. Unless I choose to use it in a different manner, then I include it as taxable income. I'll mention that a little bit more on Education Tax Credit Day. Household employee income, we already talked about that a little bit. Not reported on W-2, the non-excludable portion of certain fringe benefits such as Medicare benefits. Deferred compensation is part of any pay received by an employee that is contributed to a qualified retirement arrangement set up by an employer. While this income is not subject to tax when the contributions are made, it is subject to tax when the contributions are withdrawn. You are expected to pay at least 90% of your income tax liability as you receive income throughout the year. If you do not meet this threshold, you will be punished as an underpayment penalty. And for your self-employed people, that underpayment penalty is figured on a quarterly basis. Withholding is one of the ways income tax is paid as it comes due. The payer withholds income tax payments from the income and sends this to the IRS. The most common type of withholding from wages is paid by your employer. The earnings and the amount of information provided on a W-4 determines the amount of tax the employer withholds. If you do not have enough tax withheld to pay your tax liability, you pay the difference with your tax return. If the amount of tax withheld is more than your tax liability, then you're due a refund of the amount of the overpayment. Yes, everybody wants one. Let's just try and keep it reasonable. State and local income tax refunds are included as taxable income if in the year they receive it. If you received a tax benefit by including state and local income tax that you paid as an itemized deduction on Schedule A for that year. Report unemployment compensation received by you and or your spouse if married filing jointly on Schedule 1. Alimony and separate maintenance payments made in 2023 or 2024 in this case are taxable income to the recipient and deductible by the payer if the divorce decree was put into place prior to January 1st of 2019, so 2018 and before. Anything after anything 2019 and after, this doesn't apply. You can choose to have income tax withheld from other types of income, such as unemployment compensation, or Social Security benefits, those types of things. So that's this lecture. That's today. So we'll sign off for the day, and we'll have another one tomorrow for you. You can also see that if you look on the live tab there that I did a rapid class back in December. It's going to cover the same things. It's going to be basically the same lecture. So if you want to do more of an on-demand thing, you want to go on your own, feel free just to watch those in place of the live stream. No matter to me which you do, I just watch them. There's some information in there. So the question was brought up earlier was whether this is a mandatory class. For new people, yes, it is mandatory. For existing preparers, it's not a mandatory class, but I do recommend that you go through it, especially if you've never had an in-seat class. If you've only learning from the book, all your training has been from the book. There's some information here that I'm sharing with you via examples of how to use things that you just don't see in the book that help drive the point home. So I do recommend it, strongly recommend that if you've never taken an in-seat class that you watch these classes. There's not a lot of difference between my basic class and these rapid classes about some of the stories I use to reinforce the ideas that are being presented. It's just, like I said, there is some value to getting some real life examples to help back up this information that I'm giving to you. So I do recommend them. No, they're not mandatory. And then, like I said, for those of you that are working for us, and I consider this mandatory, if you're never been to a policy and procedure meeting, I have recorded one. I recorded one last week. I've posted it to this page. It was not a live stream, so it's in a different section of my page, but I do recommend that you watch it. Strongly recommend, mandatory practically, that you watch this policy and procedure. There's some tips in there that need to be picked up. So just do know that that's also available there for you to watch. So that's it for today. Hope to talk to you tomorrow. We'll see where it's from. Have a good day.